right? But there's a lot of people that come in the world of investing and options, right? And I'm a strong believer that a lot of new participants entered in the period of like 2018 to 2022 in terms of the stock market and people, if you guys remember the AMC, what was the other one, the gaming thing? People entered the stock market, right? More people were
This is
participants
OCC Learning.
in the stock market without really knowing the basics of options. My goal is to bring you guys from the basics understanding of it, and then I covered some scenarios on how I use them. I did use to trade SPX quite a bit before the single or zero DTs were introduced for SPX, because that added a little bit of a, I would say, upside for the dealers versus maybe the buyers, us, the locals, I'm sorry, the retail traders, right? Especially if you don't understand how they work. And I would say a lot of you guys might understand it, but a lot of you guys also, just looking in my Discord, as you guys know, I don't grow this by exponential, nor do I advertise that I am the best trader, and nor do I post gimmicks and marketing of making millions of dollars or any of that. I want to make sure you guys understand the options, right? And the understanding of the options starts with the idea that options were really not invented for profit. Is there option trading strategies and arbitrage trading strategies and options? Yeah, certainly. A lot of you guys will never get to that level. And I don't mean to, belittle anyone's knowledge or potential. Unless you're in the investment banking or any of that, you're not really going to get that. But if you're managing your own portfolio, you can learn some basics and still do okay and still protect yourself. And that's my goal. Unless you want to go into the professional path, then I can help you learn that and give you the resources to pick that up. But it's going to be a lot of sweat that you're going to go through to understand this, right? And then, of course, there are certain certifications and stuff that you have to do to get there. But that's not the goal of this class. I'm not going to go into all the Greeks that that are available, because you don't really need to know the row. You don't need to know certain things, for your simple portfolio. So keep that in mind, and then we can always build on it. I'll ask you guys at the end of the options class what else is remaining to be clear, and then we can add on the slides, add on the knowledge, so that way when we talk about options in class, or when I say I'm doing this, that you guys can actually understand. Does that set you guys on the ground, what the expectations are? I don't want you guys to think that I'm going to give you everything that I know in terms of options in one class. I would say it's probably impossible to do that. It's If
That
you
makes
want to
sense.
learn everything options, it would probably takes us every week that we do a class 2-3 hours, talk about it, and a lot of you guys would be lost in some of the stuff. But let's keep it simple and see if we can make it beneficial for you guys day to day, as well as avoiding some of the things, right? So what is the objective, right? Is really to understand the fundamental concepts, right? Including their contractual rights and obligation and who does what and defined terms. Uh, as I mentioned, contracts are basically a derivative or synthetics of underlying assets. They are financial contracts traded in derivative markets, and they're separate from your stock. A lot of people know how to buy a stock, like an Apple. When you buy an Apple at $200 today, you own one share of Apple. And that's probably a certain percentage. You're now owner of Apple, but one share of Apple is not going to give you a lot of rights in terms of owning that company. It's probably, in 1 millionth of a percent that you own that. Options facilitate in exchange the rights to buy or sell underlying asset, not the asset itself. Right. So you do have the rights and obligations side of it, and we'll cover that, right? As a buyer, as a seller, who has the rights, who has the obligations. And that's what you guys have to understand before you click the buy and sell on options. And it's very important that everybody is on the same page when you're talking about this. Because when I did this, let's say 15, 20 years back, it's quite a bit different and more automated than it was back then. Before, I posted a piece of newspapers as the options, the volatility by ETF used to be printed volumes, open interest for the day prior. It used to be printed in the newspapers. You would look at that, compare the OIs, compare the volumes. But all of that's actually given to you guys in a system, right? And you don't have to do all that tracking right now as you did before. So the options are not your stocks, and you have to make sure that you're trading either on a speculation or your analysis or arbitrage, maybe a wrong pricing of an option. There's definitely trading for that. My goal, primarily, what I do use the options for, so I do when I trade SPX 0DT, that's really not a hedge when I trade SPX, or when I trade SPY, 1 day or 2 day or 0DT SPYs. I don't trade that based on the hedging of a portfolio, but rather it's a speculation play based on what the market's giving me. Let's say, we have a poor high or poor low, and depending on the concepts that we use, is there a chance that we can appreciate that value towards the end of the day, right? And then you have the certain Greeks that come into play, theta gamma, right? They come in to help us, move the price. So we'll cover some of that here. Does everybody understand this slide? Is it comprehensive enough for you guys?
Yeah, that's good.
What do you guys think the buyer's rule is an option?
Did you say the rule, like buyer
The
rule?
role, no, buyer role is
Oh,
the
role?
buyer have the obligation or the right?
Mm, I'm not sure. I would probably just guess.
Right. The obligation.
Why do you think that the buyer has the obligation? Are you obligated to buy calls? The buyers have the right to buy a call or sell a call or sell a put, right? But the seller has a different, they have the obligations to do that. So let's talk about that. Buyer's role is gains the right. It's not the obligation to buy a call or an option as a stock predetermined strike price, right? So I got some put options for coin. Which one of you put a gun on my face and said, make sure you buy this? Anyone? Nobody, right? I
I
mean, it
see
was
what
my
you're saying.
choice. It was
I
my
thought
right.
if you buy a contract, then you're obligated to like buy all of those shares. That's why I was saying that. But I don't know.
Well, it's your right to buy, but the seller of that option is obligated to, if it's exercised, to do something, and that's the second piece. I paid the premium for this right? So I bought, I think, coin. Let me see. I think I bought like far out. 1 second, I'll tell you. 1 second, I'm logging into Fidelity to give you an idea. I bought coin 280 put for 2025 October 17. Okay. So I'm a buyer of a put, right? There had to be a seller of the put, correct?
Yes.
Okay. So what is the obligation of a seller?
To sell.
To deliver you 100 shares of whatever that contract you're buying.
Anyone else? Anyone else have any thoughts on how you can structure this to help others understand it?
The seller's obligation is to sell at the strike that you have bought the put at.
Okay. So how does that benefit me?
So, so you are you're paying the premium to buy it at a certain price point, which is probably lower than the current market price.
Hmm.
and you're taking the risk of, or rather, yeah, I think the seller is taking more risk here. You have a finite amount of risk, but yeah.
So let me give you a scenario. That's very good. Let's go over the coin. I'm just going to add something here. Coin example, right? So I have 280p, right, for October, I think 17. Let's just assume it's 17. So I don't go back. So what is the seller's obligation here?
They have to sell to you at 280.
Okay. So they have to sell it to me. But what about the relevance to the market price? How does the seller lose money in this?
If the stock price is below,
Okay. So the seller is obligated to buy what? 100 shares of coin at what price? $280 per, right? If I exercise the call, the put, correct?
Correct.
So let me ask you this: if coin is trading at 200, how does this benefit me?
So the seller's obligated to sell at 280 once that contract is in place,
Exactly.
no matter what
So,
changes.
this is assuming no IV, no other Greeks are impacted. So, are you guys following?
Yes.
Is anyone confused? Anyone confused?
Nope.
So the seller would be, in a pretty big, decent spot here to lose money, right? But most of the time, people don't exercise options, right? And you see people post, "Oh, I made 180%." You don't have to wait. I'm not going to wait. For instance, if we approach, let's say, coins start selling off, right? And we approach the level of like 280 right now, which is quite a far away. I mean, I think it's at 353 or something like that at the close. So it has ways to go, right? It has $70 to go before the value will start moving. It's up a little bit now, but not a lot. So the seller is really obligated to fulfill the contract if the buyer exercises the option. So for instance, if you guys traded corn, it becomes a little bit of a messy situation if it's exercised, right? If the option is exercised, let's say you're a buyer of a contract, let's say you buy calls and you're assigned, well, then you will physically, if you're set up for it, you will get delivery of corn. In this case, if you're assigned, let's say you buy calls at 210 on Apple and it expires and it's in the money, well, you're going to get assigned, right? And let's say the price goes to 220 and you had the 210 calls. Now, you have the right to buy them at 210. The seller of that call is obligated to sell it to you at 210. So how do you make money if it's exercised? Well, first, you collected a premium. Second, what's the other profit? Wouldn't it be the difference between the strike price and the current price?
That's what I was gonna say.
That'd be the intrinsic value of that option, right? So buyers really have a limited risk, which is what? When you buy or buy a put or a call, what is your risk?
The value.
premium,
The
Just
premium.
the premium. if I paid, let me see how much I paid for coin. Trying to give you guys some examples. So I paid $1,700 a put for coin. So my risk on this is $1,700 times the quantity that I got, right? That's mine. What is seller's risk? Right here. Whoever sold that put. What if coin goes to zero?
You lose the shares.
They will lose the shares, but they have unlimited basically risk. Like it can, definitely go to zero, right? So they could lose quite a bit of money. They have a limited reward, which is what they collected from me, correct? But potentially their risk is much higher. For me, the risk is somewhat limited because I know what I have, and you can gauge that risk based on your portfolio percentage, right? Like my position on this one is in terms of portfolio size. Let me give you guys 0.001. So considering the size, it's not much for me, but it could be a lot for somebody else. So does this make sense? The roles and responsibilities, because it'll help you understand the rest of it. Any questions on this? Okay. So the three critical components that a lot of you or new people that you have to understand is the strike price, right? That's the fixed price at which the stock can be bought, called, or sold put if the option is exercised. So when we say I'm buying SPX, let's see, I was short SPX on Friday. If you guys recall when we took the short on ES, I think it was 30 something, if I remember correctly. Let's see, what was it? So I got in, I think it was at 33-ish, 33 and a quarter on the short side, and I was targeting, I believe it was SPX 5880s at that time. Let me see what number I had. It was 6180s, I'm sorry. At that time, and that price, they went quite a bit, much lower than that. So the strike price that I selected, right, and how I selected it was based on the movement of, for instance, of ES, which is futures, and you could have done that based on SPX potential targets that you had, but I determined, that 80 was pretty good. So that was the strike price I was targeting for a put. Expiration date just means how many days before it expires, right? SPX contracts exercised on a Euro style versus American style. On SPX, you cannot get assigned. It's cash settled. So if I close those 58, and if I just, not 58, I'm sorry, 6180, whatever they were, if I close them in the money, what would that mean? If it's not assigned.
You get paid in cash, not shares.
That's correct. I would not have to exercise in shares. I just get the cash settlement. And that's a very big difference you guys have to understand. If you get assigned on SPY, and typically now the brokers have some kind of check in their system. Let's say you bought, 10 contracts of SPY, 0 DT. I think that, if your account size does not have the value, if it's close to the money, and you don't have it, or regardless, I believe, I don't know if the rules are such, but they will exercise those calls and market close those options, puts or calls for you. Have you guys had that happen? I believe that's still working, because on SPX, they will not exercise it. They can go to zero, or they can be in the money and close. They close at 415. And basically, if you're in the money on the calls, right, let's go up, they will settle it up and give you the cash settle at the end. On SPY, you can get assigned, and it will add a little bit of complications for you in case you are. So, especially if you have the money in your account to buy it, right, or sell it at a certain price. The premium, the cost of purchasing the option paid by the buyer to the seller. So if I bought the option of SPX and let's say I paid, I think I paid $500 on SPX, I sold it for, don't quote me, I can check my activity here. Let's see, activities. So I bought the puts on SPX, what was it? 61.80s I was trading with. I paid $400 and then I sold them at $640. So that's just the premium. I initially paid that much and then I sold it and I took the profit per contract at that amount. So it's just the premium and the value of the contract. Right now, you guys don't even have to worry about calculating, right, the option price because it's given to you in whatever you're trading, correct? You guys really don't have to be like, hey, how much is this going to cost me if I was to buy a certain option? So for instance, let me just copy one. So if I was to give you this option for coin, how would you guys know to calculate? Does anyone know how to calculate this? I would give you another variable about like an IV and what the IV is. Does anyone know how to calculate this? Like how much you would pay for this one? Or what you should pay for this one?
No.
Good. So that'll be the quiz on what you guys have to do next. So let me give you a scenario here. I'll let you guys read it so I don't put any bias in my tone and reading. And I want to see just one by one. Tell me, what would you do?
Buy and hold.
But this is inventory. They have to buy a lot of coffee and you don't have storage for coffee.
Well, I don't have
Sell-
enough information. I mean, because if it takes up space, that costs me.
You could
Think
reach
about it.
out to people who like own coffee or sell coffee, right? And then you would want to get a contract for coffee at $5 or maybe like slightly higher. If whatever y'all can come to an agreement on, you want to get something that 2 weeks, a month, however long you think you need out in the near future, and then kind of get a contract for the price of coffee now so you can sell it later.
Very good. That's excellent. Anyone else?
I would sell puts for $5 for expiring next month.
That's very good. That's one approach. Yeah, selling puts is. I like to do that as well. What happens if you get assigned?
I have to, I'll have to sell it, or rather, yeah, I have to either I have to buy at $5. Is that?
That's correct. If you sell a put, you're assigned. That means you have to buy. I do that a lot. I did sell, like for instance, Intel puts at $13. Right. I have quite a bit of shares of Intel. So when I sold it, Intel 13 puts, I'm bullish. Does that make sense?
Mm-hmm.
I'm bullish that the price is going to go higher. But if I was to get assigned, I have to buy those at that price in the quantity times 100.
And yeah, probably close to the expiry, I'll probably buy it back at much lesser cost. But yeah,
That's
I've not
exactly right.
traded it. Yeah.
Okay. So yeah, I could definitely sell it, but let's say I want to play with the calls. What you could do, right? Let me just give you that. If I buy a call from a supplier, let's say with a strike of $6 for a premium of 50 cents. And let's say, our prediction comes true, the price goes to $7. How do I make money? Well, if the price of coffee rises to 7, then I have the right to purchase coffee at 6 because that was my call. I bought the right. And the obligation now is on seller, correct? That's why I made that slide first. I have the right to buy at 6 because I have the legal contract to buy at 6. because I paid you 50 cents for that right. Everybody following the first slide and this slide now?
Yes.
Okay. So if that happens, I can then quickly turn around and if the market price is 7, I can sell the pound of coffee at 7, which cost me 6, correct? So my profit is what?
1.5, 2 minus 0.5.
How much?
$2 for the difference in the profit that you're making, and the 50 cents the premium that you paid for it.
But I didn't buy coffee at 5.
Oh, you did not.
I bought the contract. I bought the derivative. I didn't buy the underlying. We bought the
Just make
strike
50
at 6
You just make 50 cents.
per pound, correct? Does that make sense to everyone? It's important because it's going to lead into the next section. Is anyone confused? If you are, this is your chance to be like, Shorty, I'm confused. I don't get it.
Yeah, not too clear.
Okay. So let's put it in layman terms. I have the right by purchasing the premium, the call. I purchased a call, right? For, let's see, what are we? July 20th. $6 for coffee and paid 50 cents. Okay. Now, coffee is priced at, let's say, $7. How do I profit? Well, simple is $6. I buy it. I can own coffee at 6 since I bought the contract. And market price at 7. So the difference is what?
$1.
$100. Yeah, I'm assuming it's.
So $1 per profit pound, but I also have additional cost. And what is that additional cost?
Premium for the call.
Premium.
Yeah, I paid for the right. I paid
A profit per pound minus premium.
so my profit is the 7 minus the 6 minus the 0.5, right? So I'm making per pound. Does that help now or?
Definitely, yeah, I got it.
Does everybody else follow? Is anyone confused?
Is the premium 0.5 per pound?
That's correct. Yeah. Yeah. I just assume 1 pound.
Okay, got it.
Yeah. And if it's 10 pounds, then you would just multiply this profit by 10 pounds, right?
Makes sense.
Yeah. And in the commodities market, this is pretty much the scenario. I wanted to give you guys a non-stock scenario so you guys can relate on how that would work, right? Because a lot of people get stuck and they don't understand this and they want to trade stocks and options and then they really misunderstand the concept of it. It just gives me the right. If I buy a call on coffee, it just gives me the right, especially if the price is in the money, meaning the price is above the strike. That means on calls, that's in the money. It means slightly different on a put, right? When it's in the money. And we'll cover that. But does this now, if it doesn't make sense, I don't mind elaborating because it's important you guys understand it. It's just the right to buy something at a certain price, especially if you're bullish on it. Let's say the price of coffee went to $30. Think about the guy Like, let's say this guy, the coffee farmer, is like, man, I collected this money from Shorty, man. Like, and he charged me, let's say, he charged me $200 per contract. Or let's say $2 per contract to make this example work. And he's like, hey, what an idiot, man. He just gave me this money in case the stock price ever, in case coffee ever goes up, you know, to this price, and I'm going to be obligated to sell him at that price. Let's say something happens, coffee farms in Colombia burn, everywhere else in the world they burn. Now there's no coffee, but he has to sell me the coffee that's priced at 30. He'll have to give it to me at $6 per pound, and I only paid, you know, $2 premium. He'll be in quite a bit of trouble, right? Especially if he didn't manage his side of the portfolio properly. What happens if he doesn't have the coffee? What if he doesn't have the coffee to deliver?
That's his problem.
Okay. What happens if a person or a dealer doesn't have the shares to give it to you at that price? Think about AMC. Think about the gaming stock.
Have to buy it.
Well, I talked about the other day on the live that my broker offered me interest on my shares to borrow them to them. Why do you think they would ask me for it?
Because they owe people.
Because they need them.
Because they need them, right? When the short interest of something goes above 100%, the borrowing costs also go higher, right? Because now people are like, man, I don't have shares. Like, we need to borrow, but I'm going to demand higher percentage back because nobody has it. And it's similar concept of supply and demand, right? If, let's say there was, think about this. If, let's say, you know, this is a really extreme example, but hopefully it clicks. Let's say they say atomic bombs are about to fly and there's 15 bunkers in the United States. Do you guys think any of us are going to get into it?
Absolutely not.
Unfortunately, we would say our goodbyes. Because the price of those bunkers and that supply that it has for people is going to be limited to those willing to pay for it the most. And it's a similar concept in everything that you do here regarding the stock market, right? Supply and demand will lead to the volatility, to price increase, and perception of value. So does this make sense now? What it means to be the right and obligation? I have the right to buy something with the calls or puts, and the seller is obligated to basically fulfill that contract.
Buyer, is there any obligation to you? Or is, at that point, it's only the seller.
That's well, seller is always obligated, right?
It's
So the
only
buyer has a-
seller.
That's correct.
Okay.
Yo,
I can exercise or I can close these options and
help me wash up this
speculative.
stuff from outside when you're done.
So
But
I can do that.
I've had cases where people are assigned, like if you have a call that is in the money and it's about to expire, they get assigned automatically.
Yeah, you can
Like
be
I think,
assigned,
okay,
but that was your right to purchase and assign. And if
purchase.
I'm assigned, then the seller is obligated to deliver.
Okay, makes sense. Thank you.
Yep. Mm-hmm. So if everyone's okay on this, I'm gonna ask you guys annoyingly one more time. Does this make sense?
Yeah.
Okay.
Yes.
All right. So now I'm gonna give you guys a stock price, all of these details, so you guys can calculate it. You guys ready? Why you guys turn quiet? You don't have to do this.
I'll grab my calculator.
Yeah, you need a calculator for it. But when you think about, options, so let's see, I'm actually looking at options on coin. I'm just gonna copy them over, right? So for you guys, you already have the options calculated, for instance, right? I can do, I can see what the calls are. I can see the bid and ask, and I can also format this to give me a lot more information on an option. And then it'll give me, what does it cost, right? If I want to buy a certain, let's say, call here, it's going to cost me $2,100 at the ask, right? The spread is about 65 cents in between the bid and the ask. And I don't have to do that, right? In the back end, what happens to calculate these is it takes certain stuff about the underlying asset, right? What is the strike price? What is the risk-free rate, like treasury rate? What is the time to expire, typically in years, right? Exponential base of natural function, right? That would be here. And then distribution, and then you have to put all of this together in order to calculate it, right? I had to do this manually, right, on a piece of paper. I had to do it on a calculator, but you guys don't have to do it. So I would say 50% of the work for you is already done. Now the other 50% is you knowing when to go with this, when you become a buyer of a call, seller of a call, and that's more related to the volume trading and strategies. But I just wanted to give you an idea that a lot of this stuff's become automated, guys, and a lot of people are focused on making money instead of learning, where it comes from, how does it work, and how can you profit from it. A lot of people nowadays that I follow on Twitter, that they showcase their skills by going into details of the Greeks. That a typical retail trader, you don't need to know that, right? You don't need to know some of these things like gamma, vega, vena, rho. I misspelled professional. You really don't have to know those details, and it becomes unnecessary garbage in your brain, and it becomes kind of paralysis that you're going to experience. The two that I care about, right, especially when I'm hedging or if I'm playing zero DT, I go based off the levels that I can actually hit with the move that's expected. Does that make sense? So I'm going to give you a scenario of what we experienced, I believe, Friday. Let me see if I have the chart. All right, so let me bring it up. So if you guys take a look at this Friday, I think I was somebody might have asked, and actually when we were trading here, they said, Shorty, why don't you go short, particularly here? And then I also targeted SPX. Let me give you. So there's a cool indicator for SPX. I targeted initially to go all the way to 61.80, right? Right here. Let me make sure that that's the right one. Let me just bring up my activities. $61.80. So I played 61.80 puts from here all the way to here, right? And I held some, some appreciated quite a bit. Why would I target, from here to here specifically? Let's go in smaller time frames. So when I entered somewhere around here, I targeted this to be my exit on these. Why is that? 10 DT. So I got in somewhere around here. I think it was 33.25, somewhere around here. And then I was targeting IBH.
Because for 0 day, it eats into your profits the longer it's in there.
Exactly right. What starts working against me at that point is, let's say this bounce. When I closed, I typically close into the strength, meaning if selling is occurring, like right here, I was like, oh, time to take off. Because if it's 0 DT, and considering the time of the day, it was 1 o'clock, they bounced right off of IBH where I was pretty much in the money, right? And if you take a look at this, what would this do on a 0 DT? Let's say if they actually broke this and reverted it and went higher, what happens to my SPX 0 DT?
Becomes worthless.
It becomes quickly, guys, worthless. Actually, if I didn't sell here, it probably would have triggered a stop loss for me. So when you're trading 0 DT versus hedging, there's a difference, right? I base the levels on SPX when I'm shorting off the levels that it can reach and reach quickly on 0DTs. If I, let's say instead of 10 SPX, if I had one and I was willing to kind of play more of a lottery style, could I have targeted more, considering that, lately we've been running quite a bit? Yeah, certainly. I could have, I know of something that happened here between the IBs for sure, and I could have targeted this, right? Does everybody understand what I'm pointing to? So I would have been I would have been $30 in the money on SPX, and we don't have to calculate it, but $30 in the money on 0DTs on SPX is a pretty good return. But I was happy. I took my profits here. I trimmed some. I believe I closed some here. And that would be, ideal to pay attention to. If the move is not working in your favor immediately, which one of the Greeks do you guys think comes important? Especially on 0DT.
The theta, the
Theta.
time.
Yep, theta will be a big deal, right? The delta played a role for me on this one. Why? Well, if you take a look, was I so far out of the money when I was playing this? SPX was probably somewhere 10 points, right, higher. And I was just closing at, basically playing at the money at 61.80s. So the delta was smaller, or how was the delta price for me on these? Is the delta on puts, is it higher or lower? Is it positive or negative on puts? Is it negative on puts or calls? I want to see if you guys understand this.
So for puts, it would be negative every point move. It would be negative, and then calls would be positive, correct?
That is correct. Does everybody understand that?
Can you repeat
Does
that?
everybody?
Sorry.
The delta on the puts is negative. Okay. So calls have positive delta, meaning that with every dollar move, with 1 point move, let's say whatever you're trading, it will increase by that percentage that the delta is assigned. Like 0.25 delta means for every dollar it goes, you're going to get 25 cents. Okay. I typically, when I trade, I like to keep them between 0.20 and 0.25. Because if this delta works out, let's say it's this, the weight of it is 0.20 to 0.25, and I'm just going to bring up gamma real quick. Gamma is, it increases on the quicker moves, right? If that one wants to increase, especially on 0DT, these become really lucrative and good for my portfolio because they move quickly. Theta, in the other world, is the one that decays and kills your options, right? So let's say I got that option right here, as I did. I got the option right here, and the move was just kind of staying flat and not doing this immediately. What happens to my 0DTE? Well, let's understand what theta is. Is basically loss in value, right, as time passes, and usually expressed on per day basis, right? So when it says, let's say, negative 0.10, you will lose 10 cents per day in value, assuming the stock price and volatility are constant. But what happens to volatility on 0DT SPX?
Becomes worthless.
It accelerates much quicker towards the close, right? Because it goes from, let's say that the puts that I had were 61.80, right? And let's say I didn't close them, and actually SPX closed at 61.73, and SPX went as low as 61.40 on Friday. I mean, there was a lot more profit on that put, but once it bounced, the theta would eat you alive. It may be actually even, maybe break even or less, because it would start eating the premium really, really aggressively for you. So, has anyone heard of this?
So theta on a zero day, the way it eats into it would be almost exponential. Are you saying, because at the end of the day it's more because you have less time?
Well, exactly.
guess-
Yeah, the opportunity is less,
Okay.
and it's gonna devalue towards zero much quicker.
Right. Okay.
Yeah. In the world of trading, they say one man's theta is another man's gamma. If the move is smaller than implied, then the theta will outweigh the gamma. Does this make sense? I would say we want to make sure you understand this piece here.
Can you elaborate this one, please?
Does anyone follow this before? I just want to make sure that you guys are collectively. This highlighted piece right here. Does anyone have any idea what this means?
So theta didn't even have time to start, I guess, cutting into your profits if basically if you didn't stay in it long enough. So if like in your example you were just showing, you said you got in and got out real quick, basically on that one candle. If you would have stayed where it started chopping, you know, if say you made 5% on that one move, at the end of those choppy candles, you might have been back to, you know, in the red by 1% or something because of theta.
For 0DT, we want bigger moves, quicker moves earlier.
Because then, if not, the theta becomes much more, I guess, stronger than gamma. Because if the gamma is not, if you're not moving the stock, if the stock doesn't give you a spike like it did for me, considering we're in a massive uptrend, for a long time, if I didn't take the profits there, then I think that becomes a point of gambling for me. Because then I'm expecting that move is going to continue, but it didn't. It bounced where it had to bounce, where I was closing. Does that make sense? So if the implied move didn't happen, if that drop didn't happen, then the theta is stronger than a gamma, then basically I lose. In this case, what do you want to be? It's much better to be a seller than a buyer, right? If I sell the option, is theta working for me or against me?
For you.
For you.
Yeah. So when you're a seller, it works in your favor. So how would you guys put theta in terms of a real life scenario?
Fresh produce that is almost expiring. I want to get rid of it as soon as possible.
But give me a scenario. Let me give you. I rent apartments and I collect every month. How's that work? The theta is beneficial to me, is it not? Because every first, what do I get? As a rent, I get a payment. So if you think about it, as time goes, let's say from 1 day, to 30 days, every first reset, I get the payment. So theta, and for the buyer that lives in the apartment, he's like, oh man, I just paid my apartment. I have another 30 days before I have to pay again. It's opposite for a seller or a renter of that apartment. It's like, as we get closer, it's it's more exciting because the payments are coming in. So if you think about that example, to me, makes a little bit more sense.
So theta's the seller's constant that keeps them, I guess, afloat, if you want to say. It helps them a lot. And as a buyer, it's, you know,
Really works against you.
right, exactly. Exact opposite.
Yeah. And gamma is basically, when you think about it, it just measures the change of an options delta. So this one measures the change, and this one when a stock changes $1 or whatever. So, but I don't want you guys to worry about these three, because if you want to learn about these three, like I mentioned, and years back, we had the professor that did the derivatives class on this, and it was like 25 people in class, 4 stayed, and one of the girls stayed, I think, not by choice. She would just fall asleep immediately in the class. And so you don't have to worry about these for now, unless you get into more complex strategies and dealing with your portfolio. If you want to measure the beta and all that, then it gets a little tricky, right? Then you have to learn this. But for you guys, if you're looking to play SPX options, typically what you want to get out of it, I look for the delta to be between 0.20 and 25. If I'm playing speculative, right? If I was playing SPX, like here, I could have played something really out of the money, right? I played something close at the money, right? It wasn't in the money. I played it at the money. Out of the money would have been me playing, let's say, 61.40s. This one here, premium, was much bigger, less speculative, less, right? Does that make sense? I'm actually trying to chart the option for you guys.
Is gamma a delta of delta?
Yes.
Okay.
Yes. One way to put
Sorry.
it, yes.
Well, I mean, at the base. Okay.
Yeah.
So for 0DT, so it's wise enough to wait getting into the position and see which direction it's moving based on the delta.
Say it again. Sorry.
So for example, if the delta is increasing on the negative, so just wait before it has moved quite a bit, or for is it 0DT, or just jump in as soon as we see the change in direction and increase of
I
delta value?
Well, personally, I don't look for entries off of Greeks. I look for entries off the charts. But I look for deltas where the amount of the delta is like 0.25. Let me see if I can change this column real quick. Try to, one second. I can't bring the 80s, but let me give you this scenario here. So if you take a look, for instance, here's so for instance, here's the reading off of Thinkorswim, right? So if you guys look at this one, I'm looking at 61.70 for Monday, right? The puts are at $18, right? And the delta is 0.47. So that's pretty high up there. It's at the money, right? We close somewhere around here. That'd be at the money, right? Out of the money would be somewhere, you could target to play something like this, considering the implied volatility is pretty high. So I could target 61.40s, right? And they were okay, right? They were about $830. This one is pretty high delta, right? I mean, you can definitely play that. And you're able to see that rather easily on your charts. But I wanted to show you something when you trade the options. Let me see if I can actually detach this view. 1 second. I don't know how many of you have had this or seen this. This is the chart of the option that I played, 6180. Okay, so I think at somewhere around 3 o'clock, I was able to get in. Well, not 3 o'clock, I'm saying 1300. So it was somewhere around here that I got somewhere around here. Let's see. Let me see the price. 400. It was somewhere, it had to be here somewhere that I got in. So I got in here somewhere. Do you guys see what happened on this stock option? It went from $400 to $4,700 per option. So the question I'll lead you to ask, why would one share options versus just buying shares or selling shares?
Risk versus reward
Have a hedge.
is much higher.
And you don't have to have that much capital for options.
Exactly. The leverage, is much better, right? So if you put in, let's say, 10 options here, you put in 4 grand, and quickly, maybe this is, around 1 o'clock at 2:30, you would have been sitting on 50K. So 4,000 to 50K, what are the odds that you can see that movement in the stock? I would say pretty low, right?
Close to zero.
Yeah, you're not going to see that very often. Do we see that a lot like we did here? Yeah, there's days like where you can catch this and see it, right? It's definitely doable. So the options give you the ability to, if you're using them for profit, like I was here, they give you an ability to kind of really quickly make some serious money on it, right? And if you guys look at this, right, so they started, appreciating here, and you see there's a lot of buying, a lot of volume increase here in this period. They spiked them, they dropped them to about 13, and then a massive run from here, and then they ended them here, right? So one would use options, you could definitely use it for hedging. I do, and I can also use this for speculative profit making, which I also do. So there's a difference. And either way, I stick by the rules of 0.2025, nothing below. You can go higher, but the higher you go on this delta, the more premium you're going to pay. And then, the more time you buy, because when you buy theta or buy further out strikes, you're buying time for your, security or your idea that stock might go up or down over a period of time. You just don't know when, and you buy more time to secure yourself, like I did with coin. I gave it, about 4.5 months to drop $70. Does that make sense? The theta, does this click now maybe a little bit better?
So since theta is directly proportional to time and your strike date. How does delta change with the strike date and the time? Is delta more constant or time
No,
actually
so
affects delta as well?
well, it's more concerned about the strike and current
Okay,
price.
it's actually the level. Okay,
Yeah. So the closer you are in the money, right, the more you're going to pay, right? The
yeah,
delta is going to be higher. The further you are, the less it's going to move based on the price fluctuations. Your contract's going to be less impacted. The other variable that's fairly important, and I bring it up, is the IV. IV is fairly important for you guys when you're trading implied volatility, and that's the only, I would say, variable that's heavily manipulated. When I say that, I don't mean it in a conspiracy way. I'm just saying that based on the dealers. When a dealer who's selling these contracts is uncertain of price movement of underlying, what do you think they do?
cover their ass.
They cover their ass by increasing the IV, and you pay 80% increased implied volatility on a contract. And once the news come out that IV drops, what happens to that contract?
It's useless.
Yeah, you can't make it up. Does that make sense? right, well, let's go
Question
into
on the question on the delta. Is that only for 0 DTEs or is that anytime you take calls or puts?
I typically look for longs, longer dated or 0 DT. I like to be above this threshold here,
The 20. Okay, so
like
regardless
here
of
or
whether
here.
it's a zero, so regardless of
Yeah.
whether it's 0 DTE or 3 months out, it's still
Yeah, I typically look for something like this. So that's just my
okay.
strategy, how I handle it, right? Do I go
Okay.
sometimes higher? Like, yeah, there's times that I go higher, right?
Mm.
I rarely ever buy in the money puts or in the money calls.
Okay. Okay. Thank you.
Okay, so let's talk about in the money, right? So let's assume the stock price is denoted by S, the strike price of a contract is K. Call options just give the right to buy the stock at the strike price, gives the right to sell the stock at the strike price. I think we've covered this, and does this make sense?
Yep.
So there's obligations and there's the rights, right? So in the money, a lot of people talk about, and I want to make sure you guys are clear when they talk about in the money, at the money, out the money, and what that means, right? In the money, when the stock price is higher than the strike price on calls, right? So if Apple is trading at $200 per share and you have a long option at 190, that means what?
In the money.
I'm in the money, meaning that the option that I had at 190 is $10 in the money. So then what is the intrinsic value?
$10.
$1,000.
$10,
It's
right?
10. Oh,
It would be the price of the strike minus the actual price of the stock is $10. Because if I exercise, let's say I sell the Apple at 210 while underlying at 2, I'm making $10 per share before the premium. Does that make sense?
Yes.
So everybody's clear in the money on the calls. How does the in the money on puts work?
It'd be the opposite.
Be the S minus the K, right? Like intrinsic value S minus the K. And on puts, it would be the K minus the S. So when the stock price is lower, maybe I misspelled here, lower than the strike price. So if the strike price is 210 and current price is at 200, that means your put is in the money by $10, right? So intrinsic value on the puts is $10. Make sense? When would the intrinsic value be 0?
When K equals strike price.
When the K and S equal. Does that make sense?
Sorry. Stock price. Yep.
So if an option stock price equal to the strike price or very close, they have no intrinsic value, right? They would just have time value.
Mm-hmm.
So if I was to exercise, let's give you a scenario, right? I gave you this. If strike price is $200 and the stock is at $200, if I was to exercise this call, how much money do I make?
Less than 0 because you have your Greeks.
Premium. You have the premium that you paid for it. That would be actually a
and
loss.
yeah.
So you have no intrinsic value to exercise it. Because your break-even point would be what you paid, right? The premium minus where the underlying is. Does that make sense?
Yep.
Everybody else, you're too quiet. Free, does that make sense?
Yes.
And then on the put options, pretty much the same thing, right? Intrinsic value does not change. If I'm selling the stock at 200 and stock is worth 200, well, then I don't really get much. At the money are probably not, for zero DTs. I don't mind playing at the money sometimes, but me being, I don't play a lot of lottery. So when I do play them, I like to play what? I typically play out of the money, right? Friday I played at the money just because I did not trust the stock market that much, right? Since we've been running and we've just been grinding higher. What is intrinsic value in out of the money?
Negative.
They have no intrinsic value. I mean, it's just
Oh,
it's not like it would be stupid to do any of it, right? It's only time value, and the time is related to the movement of your delta, right, and moving underlying, right? If the underlying is not moving, you're pretty much you can forget about it, right? You're so far out, the delta is going to be super low, and you're not going to make money. If I have a call option at 200, right? Let's say I have 210 and stock is at 200. That call is out of the money, right? I'm not buying them. If I bought 195, that would be in the money. 200, that would be at the money, and the 210 would be out of the money. So intrinsic value is 0. Would you buy the stock at 200 when the stock is trading at 200? Is there anyone that would do that? If yes, connect with me after the call. I have a proposition for you. Do you guys understand how 0 intrinsic value, everybody? I hope so, right? So for instance, if you have, let's say I have I have Intel and it's trading right now at like 22.69. Would any of you buy it from me for $30 right now?
No.
nope.
Because your intrinsic value would be negative, right? You're paying for future growth right now, and it doesn't make sense. That would be your example call option here. And similar but opposite on put option, right? Would you want to sell me the same Intel if it's at 22.69? Would anyone, if you have shares, sell it to me at 18?
Nope.
Okay. So when you're trading, read the bottom. If you want immediate value but higher cost, and you sell for higher premiums. At the money, it's more balanced risk reward, sensitive to price swings, and then out of money, cheaper, high risk, high reward for speculative trades.
Out of the money would be your lotteries that you
That's
just.
when I say lottery, I usually play out of the money.
Yeah, because
It's
you can
kind
get
of
it
like
at cheap premiums.
That's correct. So now when I brought that chart over, I just want to show you guys something, a visual. Let me see if I can detach it again. 1 second. So for instance, this was the one I was trading, 61.80, correct? So it went from 4 to 50. What if I got in and I just model this here? Pay attention to this growth. Let me take a screenshot so you guys can see it. I'm just going to change this here. Let's say I looked at 61.40s at that time. You guys close your eyes because you guys are going to get wrong ideas. So at the same time, that contract, the call was, I think it was somewhere around here actually. It was trading at 30 cents, $30, $39 per contract. So some of you might be like, man, I'm willing to put $39. And then look at the return on this one. You guys see the little percentage in the bottom left box? If I move it, I can't. Like right here, pay attention to the box. Do you guys see the return on that? It says 3,300% increase.
3,000.
Right.
Yeah.
Yeah, it would
And
be.
how much was the increase on the other one?
But what is the likelihood of doing it again, or likelihood of going that high when you enter?
Hold on one second. So now if you look at this one, the 6180, there's only 1200%. How's that make sense? How's it that the speculator one made more money than this one?
Not
I'm sorry, are you asking?
Why did the, way out of money put made a lot more money, right? 6180 is only at 1200%.
1200? Yeah.
Because you took more risk.
Tell me more. On this one here, if I zoom in, right, we're talking about 3000% here. 3000% between here.
It had to move more. I mean, there was more, and you got it at a further out of the money price.
Okay, so let's talk about the concept. I'm trying to tie you guys slowly back to what I said here. When I bought let's say the 6140 out of the money put here, what do you guys think the delta was? The delta, the gamma is tied.
Oh, probably closer to 0.5, and the other one closer to maybe 0.25.
This one was
Kinda
probably
like
closer to 0.05 at this time.
Oh, cool. That big
So
of a
now
difference.
think about it, as the price started moving towards this, let's say started moving towards your strike, what happens to the delta?
It gets bigger.
It increases, and it increases and increases and increases, and you end up being in the money. So it went from 0.05, it goes much quicker. So it has higher opportunity to go, but somebody set a key piece. You also have a lot risk, right? The probability of you being in the money here versus the one that's 0.5 when you bought it is a very, very large probability that you're not going to be in the money. There's a higher chance you're going to be, I would say, worthless than in the money. Does that make sense? So one gives you a little bit more credibility that you can make money, while the other one is more speculative that you're not. Hence why I put some kind of rails around how much I want in terms of when I'm trading. And I also trade that based on the concepts, right, that we teach. I targeted here. Could I have bought 6180s and made, $40, 400, converted to 40K? Yeah, we could have done that. Okay. So that we covered this. In the money, hopefully makes sense. At the money, hopefully I explained it. So at the money is basically when it's equal, when the strike and the price of the underlying is the same. You have zero intrinsic value, and then out of the money, right, would mean that you have basically zero intrinsic value. You have actually negative. Does that make sense? And how it ties to what I presented in the first slides?
I have a question about strike price.
Mm-hmm.
I guess so, we trade levels and, say, I guess how, I don't understand, is there a rule of thumb on, we're trying to, if we're trading, it doesn't matter what we're trading. We got a level coming up. How are you choosing the strike price in relation to that level? Or I guess how far would you go from the level on your strike price? Or is there, I'm kind of, sometimes I feel like I'm leaving stuff on the table by the strike price that I choose. If that makes sense.
You are. No, you are. All of us
Okay.
are. Take a look at
We
this
all,
now. Sure. Let me give you this scenario. this was the basis for at least somewhat what I was looking for on Friday. So when we were trading here, we set the IB, right? And then you had the poor high between the two, right? The B and C, right? It was pretty weak. And then the E period came, cleaned up the poor highs, right? And then they tried to build value above the C high. Does everybody see that? What I'm saying? Meaning they tried to build value here. Is that correct?
Mm-hmm.
Yes.
At the same time, when they were building value, I posted something in a chat. I'm gonna give you guys a quick class on something else. Let me see if I can bring it over. I mentioned that there's a lot of buyers that are trapped. And then I circled a few points. Does everybody know what they were? It happened, it's right in here. Do you guys just see it? That's the question.
All the gold boxes pretty much at that same level right there.
Okay. Anyone else see anything interesting that you guys can make an assumption? Why did I? Somebody said you pretty much took the short at the high without waiting for something. I could have waited for something.
Completed option
Yeah,
at the top, and then all those
exactly
red.
the zeros. Given the POCs lining up.
Okay.
The negative delta.
Okay. Keep going. You guys are nailing all the points that you have to think about when you're trading, and it's a split-second decisions, right? So keep going. I'll point them out. You guys are nailing them one by one.
Yeah, the like second to last candle has a lot of red orders on the
This one?
top. In
Are you
the
talking about this?
circle that you circle, yeah, that one right there, yeah, all that red
Mhm.
looks like a lot of orders, a lot of
Yeah.
volume, I guess.
There is a lot of volume, and there's a lot of volume right here. But now just pay attention to what's happening right here. So market goes, as we know, from balance to imbalance, right? So if you guys think about it, we were in balance here, which is from morning to here, and then we had a buyer come in with 31,000 contracts total, and the delta was positive on that candle alone, but cumulatively delta was red. They were selling in this balance. Would you guys agree?
Mm-hmm.
Yep. So then this
Yep.
guy pushed the price higher, and now pay attention to what happens when we push the price higher. When the auction goes higher, and if you guys can relate it to any auction that you guys, if you've ever been, it's fun to go to one and just relate it to the stock market. The guy is selling a car now at 6,200, and he's like 6,230, 6,230, 40, 6,240. And after a while, somebody's like, okay, I'll go 6,240. Then they come here with a lot less volume, and they're trying to push the price higher. And then when this happened, here, this was my sign. Oh, something's not up, something's not right. And I posted in chat, something smells funny on this.
Mm.
Anyone remember?
Yep.
Yeah, I remember.
Okay. So when I saw this, what triggered? Why this here?
The zero at the top and all those orders at the top. Red.
Looks inflated.
Well, it looks inflated. This part here, it looks like somebody's selling. And the key piece that I was watching is when you're trying to push this price higher, somebody, look at the delta on the bottom. The CVD is going from your push initially of -5 to here. You double the negative delta. What does negative delta measure? And I'm just tying the dots why I took the options, then I'll lead you back to the strike.
The bid minus the ask.
Exactly. Selling versus buying.
Yeah, it's ask minus the bid, right? So to me, that's telling me somebody's really eager to get rid of this stuff here. And especially with this inflated, right? So, and then, if you look at the step volume profile, let's say look at the delta here, and we'll look at 15 minutes for a moment. Gotta do minutes. Let's see if I don't have it here. See if it comes up, and you guys will see, that there's pretty big difference in terms of delta here that you guys will see. See when it calculates. But for me, this was signaling, hey, we're going to go lower, right? And then I gave you a clear level. If you guys remember, I posted the delta chart and somebody took a bet with me that it's not going to go to that level. Do you guys recall that? 2675.
Yes, that was me. That fits the bet.
So I said most likely we're going to 2675. And how did we derive that level?
Oh, oh wait, never mind.
That was purely by delta driven level because there was no buyers in between. Because when you guys think about it, I just shared what was happening at 2675. Was there buyers here? The delta went from -4 to -7 in the box. So the only one here was maybe a fake setup at 2675 right here. But I was looking that they're going to start buying. And did they buy there initially? Yeah, they bought it. If you guys remember, they came back, they bounced it, and I said they won't lower. I said they really want to go lower here. Because this was not now support for me. This was more of a setup for a bull to get in, and boy, did they get in, right? They started getting here with market buys, and the sellers like, okay, come on in here. Let me teach you a lesson. They came in, they trapped them here, completed auction on this candle, and that's where I was like, okay, well, where can you go to? Well, the rule that I know and that I follow is we go from balance to where? To imbalance. So this was my balance. Now, if I go and look at the chart, if this was my balance previously, right here, if this is the balance, and I took the short somewhere here with the SPX, well, I don't have to stay in quite a bit, right? I can just target this, and if the move happens right here, I can be at the money with those SPX options and gain money quickly. Because how much would the contract have moved if I took 61.40s and it moved 5 points? How much would my contract move at 61.40? Like right here. It would have moved pretty much maybe a few pennies, guys. The move wouldn't have been. But this move that I got, I trimmed, I made money. You keep some runners, and these can make money. But if I played speculations out of the money, these would have been, like I showed you, it went from $40 to $1,500. So speculation has a higher reward, but also the odds of you getting it are much smaller. Probabilities are very, very low in options. So I use what we use to determine the strikes. What do you want to play, right? Do you want to be more sure money? Well, more sure money was me targeting 61.80. It was the IBH high. If they crack the IBH high, which pattern is in play then? That we trade.
80%.
Yeah, you have
But
the
you have a low.
IBH. You have a failed IB. The odds, and remember what it says on failed IBs. Do you guys recall on the slide what we had? Just gonna find it here for you guys so you can remember. Circle here on the bottom right. What does it say? What does the first bullet say?
Revisit the opposite extreme of the
Okay.
IB.
Let's take a look. So,
What happened
and
to-
that's how I would target it. So now let's say that just that piece of information, this is definitely a failed IB, right? If you go here. So you tried here and you failed. Now the target, next target you could have played would have been here, and on SPX, sorry, that would have been 6150. So a speculative play out on the money lottery, you could have targeted 6150, correct? At the money, this is what I used. Something in between could definitely use the POC, right? But typically I would go either this or this, depending on how's my day, how's the setup looking, and then what the footprints were showing. Does that make sense how I select them?
Mm-hmm.
So more
So-
speculation, more craziness. I would have picked 40s or 50s. More sure money trade would be me at the money, and I would pick that. And then always the middle target, the POCs. Because if you guys looked at this day, something was happening here at the same time. I'll shorten this so you guys can understand. So I'm just picking this data right here. Before we went down, something was happening here. The POC shifted greatly, but then they failed to hold above the POC. And that's when I said something smells funny. Because if you went up here, right, and if you look at this, you go up, but then you're failing to hold the price above the fair price of that day, that means you're exhausted, that you do not have any buyers.
Mm-hmm.
Does that make sense?
So the combination of that pre-setup, you kind of knew what they're doing, and then you saw the sheet you were just showing us prior. I'm sorry, with the footprints and like those two things. It's like, and the fact that it was being exhausted. It wasn't just one single thing that made you
That's
think it was
exactly.
fishy. It was multiple, I guess, indicators.
That's correct. And here, if you look at market auctions, telling me they're failing to find what?
A higher level.
That means that there's some exhaustion. And, this was happening around 12:30 when I mentioned it, right? And basically at 1:16, 1 o'clock, I gave somebody some warning signs. And this is what I wrote on for people on Twitter, whoever follows me. I said, bull's tired. At 1:16, let's take a look, right? And then at 1:16, what happens?
Dump.
They are tired. They're exhausted, meaning that there's not enough idiots to keep buying all-time highs. And of course, right, you get your bounce. People believe that prior to POC was great value, lifetime opportunity, and they bought it back up.
So the rule that you showed from the beginning of the PowerPoint about it dropping back to the previous or the opposite, the extreme opposite side, is that I don't want to say a concept. That's a pretty standard.
That's a rule that
That
I
is a rule.
go
Okay.
off of. It's a
Okay.
setup that I typically play.
Right. Okay.
Yep. So this definitely works out a lot. You can go test it and figure it out. Like for instance, we tested the spikes free in the team. I gave them data and they tested it and it came out 67% or 65% of the time. When like for instance, L period makes higher high, that we follow through with a successful spike. When you think about odds and probabilities, if I tell you 67% of the time you're going to make money on this, if you put money here, that's a pretty big advantage in casino. If you're in casino and casino is giving you 67% odds, I would sleep at that table and I would empty them out.
Absolutely. I mean, what's your
But
bet in the
people,
casino? 2.3 or something?
yeah, it's
not
skewed
even
even
good.
worse now. Yeah. Okay, so now thinking about, some of you guys might have long-term portfolios. I do, right? And we do. I think I misspelled hedging, by the way. So I do a lot of hedging on a portfolio. As I said, options were initially invented for hedges, and a lot of retail brought it in to make profit because of what we covered. Why? Because of the capital outlay that you have to have on options versus shares. For you to make $1,000 on Intel, right? How many shares you have to do, and how much does the stock have to move? Well, let's say I have 1,000 shares of 19.5. How much does the stock have to move for me to make $1,000?
$1.
1,000 points. 1,000 points.
Well, it has to move $1 if I want to make $1,000 on Intel. If the price is 19.5 and I have 1,000 shares and I want to make $1,000, it has to move a whole dollar for me to make $1,000 profit, right? On options, I just shared with you that you could invest $40 and make $1,000. So that's why I say, the reasons why. For me, I use it for both, but a lot of times I use it for hedging. So I'm giving you examples on how I hedge my long-term portfolio. So let's assume, right, I do have a lot of shares on Intel, but I'm just giving you equal numbers. So for the purpose of math and understanding it, if I have 1,000 shares of Intel at 19.5, what can I do to protect myself in case Intel drops before it heads to 50, 60 per share? And current price, it is 22.69. Simply, I could buy a put, right? Does everybody know what a married put is? A lot of you guys might not call it married put, but
No.
I mean, I'm assuming you marry it to what your constant price of your shares, your average price of your shares, just to cover you in case it drops.
married put means that I have the shares, that I'm underlying protected, that I'm not naked shorting or something like that. It means that I have the shares in my portfolio and I can write against them. Okay.
Okay.
So in this scenario, I can buy 10 put contracts of December, right? Which gives me a lot of time for $20 strike puts, which is, about two and some change above the price now. So they would be in the money or out of the money.
Out of the money.
Careful.
It's a put. It's the opposite. Correct?
Told you. I told you guys it's gonna be a class where I give you guys some challenge instead of me just talking.
Right. Come on, 10 push.
Current price is 22.69. I'm buying this put. Is this in the money put or out of the money?
That would be in the
Out
money.
of the money.
In the money.
In
In
the
the money
money.
for a put. Yep. So, yeah.
So let's go back here. That's why I put it structured in this way. Put options in the money when the stock price is lower. Sorry, I misspelled lower than the strike price. So is this what's happening here?
Mm-hmm. Yeah, you're at 22.69 and you said you got at 20. So for a put, we're in.
Buying this in the money, right? Because if I
You said the current stock price is $22.69, and you bought a strike price of $20. The current price is higher than the strike price.
okay, so am I in or out?
You're out
Out.
because
Okay.
yeah.
Okay, because you're out. Where will be the in the money here?
Once it goes below $20, once
Uh,
the stock price goes below
what strike put should I buy to be in the money already?
like 25,
23. If I buy
23, yeah.
23, I'm then in the money. So this is a out of money strike on the puts. If I wanted to be in the money already, then I could just buy 23. The delta will be higher on the move, right? You could do that. But this gives me a better leverage, and I'll explain here why. So let's say that this is a rough estimate how much the price contract is at, let's say 250 per contract. So if I bought 10 of them, right, then you would just take, if this is here, then I would pay $2,500 for 10 of them. So far, so good. One contract equals 100 shares, right? So if I have 1,000 shares, where I said that, I can have a married put for 10 contracts. So far, so good.
Yep.
Okay. So what happens if Intel falls to 15? What is my protection in this scenario? Can you guys?
That
So
would
if Intel
be
goes to 15, I still have the right to exercise to sell the puts, to sell it at 20, correct? Which will limit my loss a little bit.
so it'd be the profit of the put. I guess to calculate your loss in that sense, it'd be profit of the put minus your long-term hold, just to
Exactly.
and whatever that delta is.
Yep. So that would be the right way to look at it, right? So the effective floor would be 20 minus the 2.5 of premium, which would be 17. What happens if Intel goes to 50? What happens to my put?
Not good.
They go to zero.
They will basically they expire worthless, right? But what it does for me is I would lose the 2,500, right? I'll lose the 2,500, but it protected me just in case something was to happen, and my stock gains would be 50 minus the 22 minus 69, right? Times this would be my profit.
Right.
But
So
that's
essentially,
not
you have
my
very
net.
cheap insurance.
I have a very cheap insurance in this case scenario where my profits would have been 27,000, but I had to protect myself a little bit, right? Which would be this is my protection, and my net profit would be 24.8. This is one way I can handle it right now with Intel. What's another way I could handle it? And actually, I did.
Intel,
You just sell calls, sell calls
Yep.
at
You go the
23,
opposite way.
25. Yeah.
Okay, I could sell maybe 50 calls for December, right, and collect the premium. That's not a full hedge, right? That's just a discount hedge. Because I would just collect the premium, and then as we get there, let's say, I sold 55 calls for December, and the price comes in to 50. Let's say it's December and it's a week away. I would start shaking a little bit. Because what will happen if I get assigned?
You're
If
obligated.
you sell calls, do you get assigned or do they take your shares?
Well, I'm asking you. So let's see if I sold, let's say 55 calls, and the price closes at 55, what do I have to do with my shares?
I thought then they'll take your shares and sell them at that price. Like if your call was like you sold the calls and they're $50 calls, then they'll sell them at $50. So you'll have gain.
You have to give them up. You have to give
Yeah,
up
you
your
have
shares
to
at that
give up.
price.
Okay.
Does that make sense? Could I also sell the puts on Intel to protect myself if I'm bullish on the stock?
Mm-hmm.
How does that play? If I was to sell $13 puts for, let's say, 2 months out, let's say October, I don't know, what are we in July? Let's say I sell it for September. I sell $13 puts. And I sell September at $13 puts. What does 10, let's say I sell 10 of them. What does that do for me? Am I betting that it's going to go down or up?
Up.
Okay, I'm selling the puts. That means I believe the price will go away. So I'm trying to give them to somebody who's willing to bet that price is going to go lower. So if the price was to drop to $13, what do I have to do if I sold the puts?
If the strike price was 13, then nothing, right?
But
They
the
just
price
expire.
closes at $12.96.
Then you would get assigned the shares at $12.96.
I would have to buy the
Right,
shares of
13. I mean.
Intel at $13.
Yeah, 13.
Yeah, but if they close at 13.10 and by the date of the expiration date, then I would get to keep that premium and get to keep my shares. which in other words would what? What would it do for my average price of 22.69?
It would lower your cost basis.
It lowers my cost basis. So I do that sometimes when I have a stock that I want and I can't get the strike, like I can't get the price. I mean, I could sell Apple puts like 150s, collect a bunch of premium, right? And if it gets there, then I just have to make sure I have the money to buy it. One contract, 100 shares. 100 shares times 150. Does that make sense?
Yes.
I just have to make sure I have the money available. Okay, so this is one way that I also, this is a simple way. This is just straight put. There's something also that you can do that I do, and it's called a collar, right? I buy the put options to protect the downside. Let's assume that I buy the same one, the $10, 2025, 20 strike. And then I can also sell the call options with a higher strike to offset the put costs. So if the current price is 22.69, this is how that would look like, right? So if I buy, let me make sure where I'm at. So this is the same as protective. Now I'm just, what I'm doing here is I'm lowering the cost of these guys. So instead of paying $250 per contract, I'm going to sell these calls for, let's say, the same expiration, but I'm going to sell the 30 calls. Okay. This would give you a little bit discount here. So you would pay maybe, you would receive 180 for it. So if I received $1,800 on these calls and I paid $2,500 for the protective puts, for the straight up puts here, then my net is what? The net cost is only 700. I do this quite a bit, especially on like Tesla and the higher priced options. And do you guys understand why?
And there's a typo in this slide too.
Where did I type now?
On the top, the heading.
Oh, yeah, I think I copied the same slide over and just updated the model on the bottom. But does this make sense though?
Mm-hmm.
And how do you pick these strikes? Let's see now. This is the key. How would you guys know to sell these calls?
At your profit target or around there?
Like maybe slightly above the profit target, you pick that, right? If you take, for instance, if you take a look at Intel, let's just take a look at Intel for a moment, right? So if you take a look at Intel, hide this here. Actually, I probably have a chart on Intel already. So if you take a look at Intel, and what we've been looking for Intel to do is we've been targeting to buy somewhere on the bottom here. And we've been looking intermediate levels for sellings at 23. The next level would be about 7-ish, and 28, 29 would be the level where it's potentially getting into an explosion level if it can crack this last value where they traded happily before we gap down, right? So if I'm looking to protect myself, I buy the 20 puts because that's the range that it's in. So I'm buying this here. So if it goes down, I'm going to appreciate on those puts. But if I sell these calls as this is going lower, what's going to happen to these calls here? The price is going to go down, right? On those calls, since I'm selling, they'll work in my favor as long as we're in this range. I can profit on the calls going down. I can profit as the price comes back down here off those $20 puts, and I'm profitable. But what happens if, what happens if the price goes here? and I have the same setup. I bought the 20 puts, and I sold the 30 calls. So I'm short calls, and I'm long puts, and the price goes up.
Your profits on the long-term stuff and the puts and calls cancel out.
Okay. So
Is that
my
proper?
Well, think
Just
about it.
think about
Also
that.
the shares. So now I have also the shares, 1,000 shares. Price goes from average 22.69 to, let's say, 28.99, 28.92. The difference is profit per share. My puts, $2,500 investment. What happens to
Oh,
them?
you had 700.
I was long on those, right? I bought calls, so this is a loss. My calls sold right here. As long as we stay below 30, I collect a premium of, I think it was 1,800, right? So my total loss would be what? 700.
700. Yeah.
So ideal spot for me in this whole scenario, and this is that we close below 30 by December. And then if you think about the model, right, then instead of having the what I covered here, right, this would change a little bit. Instead of 2,500, what would this number be here? I gave it to you, and I got it on the next slide. My cost would be reduced by selling these calls, right? So instead of paying 2,500, my exposure would be 700. And as long as we close below the 30, then my cost is a little less and my profit's a little higher. But there's a concern here. And what is the concern in this model?
If you only went down, I guess. If you went below the, something to do with the put. Hold on. Sorry.
Is it that you've blocked yourself like between 20 and 30 only?
Yeah, I did block myself. But as the price comes to 30, that's where something happens, right? Where I can lose more money or miss some stuff,
Yeah.
right? Because if
Yeah.
I sell the calls at 30, right, strike, and let's say that they get assigned, what do I have to do?
Give up your shares.
Okay, I have to give up my shares, but the price goes to 50, then what happens?
You only get 30 for your shares.
I would only get 30 for my shares, right? I'm basically capping my gains above 30 because I would have to get rid of that, right? So I would have to sell my shares at 30. I would lose money on 2,500, right? I would collect all of this plus the gains on the stock. So 22.69, right? Minus the 30, that would be the gain per share, which should be here. Does that make sense? This piece. Gain per share would be 30 minus 22 minus this. Does that make sense? Why the negative 0.7 per share?
The difference between the puts and the calls.
It's this right here.
Okay.
Did I lose anyone? Who's lost?
I'm a little lost, but truthfully, I'm having some bad service, so sometimes I can
Let's
hear you,
blame it.
sometimes I can't.
I'm not having trouble hearing you. I'm not lost. It's just not a strategy that I need. So
That's fair, right? I mean, it's not something that everybody does, but I'm trying to give you an idea what I do to hedge myself and how I use it. So in this case, since again, I bought the puts, I buy something, I have to pay for it. When I sell something, I get something for it. Here, I paid $2,500. Here, I'm selling something, and making $1,800. So the net difference is I'm out $700 for this scenario. Okay. And upside, like if we were to, let's say if Intel goes to $50, calls are exercised at 30, that means I have to get rid of my shares at $30. Somebody wants to, they have the right to do what? I'm obligated to let them go at 30. They have the right to do what to those shares? Buy them from me at 30. Does it make sense, the obligated versus the right?
Yes.
Yes.
Okay. So my profit here in this scenario would be $6,610 in this scenario, 1,000 shares. And it covers pretty much everything that you guys have, minus maybe a commission here that I did not include, but on 10 contracts at 20 cents a contract's not a big impact.
So is it wrong to the 700 is essentially our premium now?
That's correct. That's the premium that I paid
Okay.
for this protection.
Okay, got you.
Ideally, in the ideal world, that we wouldn't want the price to go above 30.
Mhm.
Because I missed the run to 50. What if I added, I'll give you guys another scenario. I didn't write this one out, but I also buy calls, 10 contracts of December, let's say 50 calls. What would that do for the upside? Would that be a better play for me if I'm extremely bullish for Intel? You could definitely do it, but you would be limiting yourself quite a bit on the in the term of the structure of this 3 legs. So I would not necessarily do this just because of the shares that I have, but I also wouldn't limit myself on this piece right here on being $10 out of the money.
Especially
You
not
could
on the
definitely,
upside, right? Like if you're gonna limit yourself, you don't want to limit yourself to that side of it. You would limit
no, the
the
bottom
negative
side.
side? Right.
That's
Okay.
right. Yeah, I would limit more on the bottom side, right? This works, but especially if you're in a balancing market, this would definitely work, which, you could definitely do this and not buy this portion right here. This could work because as long as you hold below 30, you get to collect this and you hedged yourself for $700 on a, think about it, on a $22,000 investment. That's not a bad hedge. I'll take that, any time of the day. But as you're approaching these $30, you really have to monitor Intel at that point closely.
Yeah,
What
so
about
this
one here? Go ahead.
so this method would be, I guess, in the sense of hedging. I'm not going to say the word manual, but you got to be paying close attention to it in a sense. Just
Yes.
it's not like set it and forget about it type thing.
No. And this one, you'll have to make some decisions. If the
Yep.
price is at $30 and it's nearing that December, you're going to have some stuff to do, right? You could reverse it, you could add a leg to it and handle it, right? But you would definitely need to monitor this and see if you get assigned.
Mhm.
So that's one example how you can do it. And probability of this one working out, probably pretty high. Another one, and this one is, I want to ask you guys. Same scenario, right? And I assume the current price, I'm just changing this piece right here. I'm assuming the current price of Intel and AMD is a 50. What I typically see, if I see that that stock can go higher in the long term, but for short term, it's going to take a break and reverse, I have an approach to deal with that as well. When this happened here, a few of us in the Discord, I would say when this happened here, if you guys remember, we had, I think 2025, we bought, don't quote me on the year, I think January of 2026 here, we bought the calls for 30 on Intel, like a year or two out. I don't know which one it was. As the price went up, I closed those calls, and I also had the shares. But what did I do here? Did I sell all my shares here?
You bought puts.
You could definitely buy puts. Yeah, that's pretty good. Buying puts there is good because it gives you a pretty good reward downside. What's another approach you can do?
Sell calls.
I sold a bunch of calls here. Because if you think about it, right, for a period of time, Intel's been, I'm talking about very long time. So let's take a look. So Intel from here to here at that point, 200 days in this range, right? So when the price was arriving here, right, my shares were up nicely, right, almost, $8 a share. But at the same time, I'm like, well, I really want to protect some of these profits that I have on my shares. And then, you went above this value. And when something goes above value, it's advantageous to who?
Others.
It's advantageous to sellers. So what I did is this, right? I sold the covered calls. They're covered because they're basically married, right, to my shares. If I didn't have the shares and I sold them, what's my loss or risk? If I don't have the shares and I sell the calls, what's my risk?
Premium.
Premium, right? And I have to basically have the money and I have to have the ability to buy those shares and give it to them, whoever is at that strike price, right? So you want to not do a lot of naked stuff. You want to make sure at least you have some coverage when you're selling covered calls or puts, right? You want to make sure you have a little bit of protection. So when I sell call options against your 1,000 shares to generate income, it's basically is just a cushion to help me retain some of the profits. It doesn't directly go to my average share value, but it's almost like on your account. Let's say, I have 1,000 shares and I made, $8 a share, $8,000. Now, and I see that price is most likely going to go lower. Well, I can sell it, collect the premium. So let's look at a scenario. It's not a full hedge. It doesn't guarantee a floor, but reduces basically the effective cost basis. Okay. So if I sell the 10 contracts of December 55 strike calls, I could collect this premium and $3,000 received. I just collect the money and I could put that towards, maybe buying more shares or reducing the average. If Intel falls to keep 30, keep the $3,000 premium. My basis would be, effective basis would be the, 50 minus 47. Oops, I didn't mean to do that. Does that make sense? And this would be my new profit retained here. Upside, if it rises 60, calls are exercised at 55, then, you have a little bit of limitations, right? You will have the gains, right? You will have this difference here. Profit would be this plus the 3,038.5. But I have no downside, right? If it's exercised. So what I typically do, like I said here, when we came here, when we came to this level, I was selling in this scenario here. As we approached here, I was selling, I think it was April or something. I was selling 30 calls on Intel, and I collected a premium. I think it was $320 or something like that at that time. $320 per contract. So if I sold 10x, that means $3,200 profit. And if let's say I only had 1,000 shares, right, and it went from 1850, let's call 1960, whatever 9 said, to this, $8 was my profit per share. So let's simplify it, right? So $8,000 profit from the shares plus the 3,200, right? But if I take the 1,000, right, you can figure out what is that adding you per share, the $3,200. Does that make sense? $3.20, like it's lowering it for me. It's giving me some cushion that I'm going to keep that $3,200. So if it drops to a certain level, like it did, like here, it still gave me to keep some of these profits that I made here by collecting the premium and offloading to somebody else. Does that make sense?
Yep.
So that's another typical scenario that I do on long-term shares. Where does this help you guys with some of the options, at least how I use them? And where do you guys want to go into the next session on options? I think this is a good intro level without confusing the crap out of you guys. I just want to know what is your feedback and where do you want to go next in terms of options?
So yeah, I kind of had a question about when you were saying how you picked the delta and all of that for the strike prices. Could you kind of show us what it would look like if you were trying to play, like, let's say an 80% on a weekly, like where you bought maybe, I guess, I don't know how much time you would get, like maybe 2 weeks out or 1 week, and kind of how you would look.
So here's SPY. We're just gonna delete some of this stuff here. Let's look at PVP. So let's just take a look at SPY here. So here's our weekly. There's a little bit of concern here already. You guys can see. What is the concern in SPY?
Well, it's already lost the value high, so it's probably likely going to at least go and revisit the PLC.
Yeah, there's a very high chance, right? So this is our weekly value area high. So she's asking, how can we play this and what do you play, right? So here's my thought process on it. So this is the 80% rule start. The bottom is right here would be the value area low, the ultimate target. The POC didn't shift up, meaning there's a chance that we're going to have some buyers coming in right here, which is our middle target, right? So if I look at this, that's about $7 away, right? So let's say I would target probably a 605 if I was playing far out of the money. If I was playing to be conservative and to make for sure money, I'll probably go somewhere in between this around 610. I would have the 610 puts right here. I would buy, let's see. So if I buy weekly puts, for 610p, that would give me some leverage, right? And based on the volatility, there's a high chance that this can play out, right? $4, but they dropped it just recently about $6. So to give me this, you could definitely trim some, and then you could target this and this. And I typically would base it off of the POC, and then if there's any LVNs like this one here, I would target that. But this would be the one I play this, or I would play anywhere between 607 and 603, so probably 605, which should be also like prior all-time high. So once they come back to 605, I would look to close all the puts, but that's what I would target, probably 610 or 605. And also depends on the premium, right? So I can tell you that real quick. Not much. So this Friday, well, we got to look at Thursday, right? The 3rd, because of the holiday. Let me give you a scenario. So what I would go in my mind, I would look at the 3rd, and 605s are at 90 cents. So they're fairly cheap, right? 90 cents for on 80% on the weekly, that would be here. If I go with 610s, right here, they're going about 182 right now. So I could buy, a couple here of this one and buy some here. And especially if, let's say, on Monday or tomorrow, we go above here and then we lose this level, then there's a pretty good chance you're going to get this and this here. So both of them, I would probably target with the quantity, either this or the 605s here. This one would appreciate more in terms of reward. This one is more short money.
And what like time would you look for? Like just a week?
Since this one is a
Because sometimes I
shortened week,
notice.
this one is a shortened week, right? So you could play Fridays. I would typically play a week out, right? So if that happened, let's say on Friday, I would have played, let's say July 4th was a Saturday, I would play that July 4th Friday out. I would give it a week or 2 weeks, typically 2 weeks out on 80%
Do you
on the
choose
week.
like that kind of like was my next question. I was going to ask you this. So sometimes I notice how like 1 week will have, a more expensive price, and then the open interest, let's say, is, over 1,000, but then 2 weeks out, it's even cheaper and maybe even more open interest, like 2,000 or 3,000, let's say, just almost double. Which one would, like you go with the 2 weeks out, or would you still do the 1 week? And sometimes I don't understand why, what is the big difference, I guess.
Well, the biggest difference when I choose this is the move and aggression that we've seen. I would say if I was to look at, for instance, SPY right now, there's been a fairly, I would say, pretty aggressive move since the lows, right? Since 470s or whatever the level was. It's pretty steep move. So if I'm playing the weekly here, right, and you see the structure is not really great on the whole run. But in terms of the weekly growth here, it's also not great. There was a couple of gaps just last week, 1, 2, you have 3 gaps last week. So when it starts moving fast, it's going to move. When it starts dropping, it's going to go fast. So could you target, in this scenario, could I play literally this level here, play like 605s here? Yeah, certainly. And I'll play it for 2 weeks out because I know the structure doesn't really support that boring drop of doing this a little bit, this, if this starts going like it did here, it's going to be a quick drop. So I would play this for 2 weeks out. If I'm looking, on a longer term structure, I'm looking for, let's say, monthlies. Well, then I could definitely find a period of time that it took to get there, right? And I don't see necessarily clear signs yet that we want to just enter yet, right? Because we need to lose this 603-ish level to start accumulating puts for downside. But if they do that, then I would target probably, what are we in June? I'll target October. And based on this run up here, right? So if you go here, I would look for something like in between here and here. I would probably target 560s, like for October, which would mean that I'm expecting a drop between here and here, about 7% drop. So how much does the stock market move per day? Like, right, you can say maybe 0.5%, sometimes more. And then I would multiply that kind of to give me an idea how long it can take, right? And I protect myself typically on monthlies. On a longer scale, on the weeklies, I typically and usually go 2 weeks out. So like this one here, I would probably
that makes
play
sense.
July expiry, like July 18th on SPY. That's where I would target these with. And I'm pretty sure that might play out.
Looks like a good play, yeah.
No, the bill just got passed as well, so that might throw some twists into the market coming up on Monday. By Senate, I believe they passed. I don't know if I read the news correctly, but we'll check.
Yeah, I think so.
Okay. So I would say this was an intro level class, at least the way I think about options. And a lot of people go directly into you buy a call, you sell a call here, but I think it's important that you guys understand the underlying of the movements, who does what, the movement of obligations and responsibilities of each, that we can talk about regularly. Hey, I'm doing this. What's a scenario how I can hedge, protect myself? And then if it's for profit, I think we can talk about that probably next. If you're trading SPX, we can go into more detail, and I could probably share my toss screen one of the sessions and explain how I trade them. It's a different setup when I trade SPX than it is when I trade futures in terms of 0DT. My screens are different. The execution is very different on my screens. Give you guys an idea. Let me see if I can somehow move this over. Let's see. Trying to copy stuff over a little bit. Let me see if I can bring this over. I don't know how it's going to look on this tiny screen. Looks a little awful on a tiny screen. But for instance, the way I trade is that I would bring over the actual option that I'm interested in the screen, and I would have an active trader here where I can do quick buy markets, or I can place the orders on the DOM here, and I can execute quickly on the option screen where I don't have to go. A lot of traders would go, click here, and then they would click this, and they would click, buy or sell from here. I don't do that, right? My screens are set up a little bit more efficiently, and I think that would be the next step where we go. And I don't know who trades what, like in terms of brokers. I use Toss a lot, right, for options. And I have multiple accounts where I trade, whether it's individual or my kids or Roth. But you can definitely set it up where, it doesn't have to look like all this shenanigans that I have, but this piece on the bottom right becomes fairly important. This right here on how you execute the trades becomes super, super duper important, because options move, I would say, rather quickly, especially on SPX. It's a matter of seconds, especially if you guys see me, and sometimes when Dirty joins on the call with us, when we trade SPX, it's a matter of seconds. Sometimes the contract jumps like maybe $200-300. And by the time you click somewhere, you come back, go another screen, you might lose a lot of time, and time equals money in SPX0DT. So I think it might not be a bad idea if I give you guys a tour, like a live SPX trading session like we used to do before, especially on Fridays, and I'll kind of share the screen and show you guys my orders as I execute them using the screens. So I think that would be good. And
That would be amazing.
I don't know what you guys use, but I can show you what I use in terms of TOS and options, right? And how it's set up. And then if you have a desire to open TOS accounts or Ameritrade Schwab, sure, you can do that. But to me, that's it's an intimidating platform at first, but once you learn it, it becomes less intimidating. And I would say it's one of my favorites to trade options. Fidelity, I have it for options as well. It's just clunky. I use it a lot for long-term portfolios. But TOS I use more for futures options. Also have trade stations for options. I have Sierra Chart, not a lot of money there, but I have Ninja. That's the platforms that I use. And then I use Quantile for footprints because somebody helped me set it up where I don't have to pay any more for like the monthly cost that I pay $100 before. So that's.
Did I see footprints on your TOS? Do you have put on that bottom right corner? You had
that's monkey bars. That's just your market profiles.
Okay.
Yeah. So TOS has like the market profile, right? The same setup. I think you're talking about this. Let me just detach.
So do you have to pay extra for footprints on Quantar?
Yeah, I paid $100 for the whole package. So this is what I think you're talking about, whoever's asking, right? So this is my basically volume profile and monkey bars, as they call them here. So this just stays on. I have it on one of my screens, and it stays on, so I can see clearly, where's the IBs, the shift, the shapes, the profiles without zooming in much. I don't add single line to this profile here. I don't add any drawings here. Rarely do I add anything on this chart. This one stays clean as this one, just so I can see the growth, the structure, the overlap, the values, the IBs, POCs. That stays constant.
Jody, did you get a chance to do the clouds? I was late to the call.
Not yet. We were just talking options the whole time.
Okay, great. Thank you.
Yeah. So we'll talk about clouds next. Let me bring them up real quick. So let me talk just one quick second for options. What would you guys like to see next? Now that you know some of the basics, what do you guys want to see next in the options? I know what I want to cover. I want to see where do you guys want to go.
For me, I want to trade more options out from so I'd like to, I guess, to start with how do you screen the options that you want to trade, and then setups for 0 DTE or daily, and then weekly, and then longer term, I guess, would be my suggestion.
Sure. Okay.
Yeah, I'd be really interested too to see how you choose which ones you play versus, like the setups kind of thing he just said.
Okay, so we can talk about this, and this won't take a lot of time. And majority of the setups, or I would say 80% of the setups that come in for my swing on options are driven by volume profile or clouds. And we're about to talk about clouds. And then, of course, the weekly, I just explained on the SPY how I look at it. But there's different content that you have to be, right? And just because you lost value area high doesn't guarantee or give you higher probability. So we can talk about this next. That's fair. Okay. So hopefully that helped you guys somewhat understanding some of the options, the basics of it, and then next we can apply how do you pick them. Then look at more detail, like what does Delta do, bring up the options and kind of diagnose them so you guys can see the actual results.
Yeah, that was very helpful. There's so many different option strategies. Just having you walk through reminded me of some that I could be using, but I'm not.
Yeah, no, I mean, you can get lost and kind of in a between the trees and you forget to see the forest, right? A lot of us do that. I do it as well, where I'm like focused on day to day and I'm like, oh crap, I also have to do this for my long-term portfolio, right? And I have to make sure these things are correlated. So, yep. So let's talk about clouds, right? What the clouds are, and you guys on TradingView, you guys have the clouds, right? And there is a slight difference between the clouds and toss and toss, right? And it's not me that's making this different, right? It's actually that just the calculation and how TradingView versus toss also calculates the closes on candles, specifically 4 and 8 hour candles. It differs. So the result in the formula in the code also differs the results when it calculates it. But it should not really be a drastic difference when you look at the monthly, quarterly, weekly cloud. It should be relatively close on a larger scale. So what are clouds, right? So is everybody familiar with Bollinger Bands?
Yes. What's this indicator called? I'm not sure I have it. Is it just shorty?
So the Thinkorswim, I don't hand this one out just because there's a lot of proprietary code that I can protect. Right, so if I was to go here, right, and give you an idea, so if I go here, there's a lot of code that sits here, right? So I wouldn't hand this out because I can make sure, hey, don't share with the whole world type of deal. So typically I don't hand this out. Typically I offer it and then you have to sign an NDA to make sure that you're not going to be distributing or sharing with people. But I do give you a TradingView license to the same code. So if you don't have it, you can tell me and then I can make sure that you guys have the license for it. So under indicators, you guys will have like invite only indicators, right? And you can see here, for instance, the shorty clouds. That's something that you guys would have. And that's going to be called SKC. And you can see here, you would have the daily, the weekly, the monthly, and quarterly clouds. So for instance, let's just kind of look at the monthly clouds and then I'll kind of explain what they are. Clouds don't really care what your candle is, right? If you're on a monthly cloud like we are right now, that's what I checked here. You just don't want to be on a 3-minute chart because you're just gonna maybe not even get a line and you'll see that, it doesn't give you a full picture because the purpose of monthly cloud would be that I look at the longer picture, right? I use monthly clouds for longer term purchases and longer term understanding of cycles. Quarterly the same, and then half a year is really really large cloud in terms of price action and what happens in between. And then when you look at the yearly cloud, that's those tops and bottoms happen every 20 years or so. That makes sense. Unless there's a black swan event, then it takes a little bit less. I'm sorry. So what these clouds are, it's basis of the ATRs, meaning the average true range of a stock and its movements over the period of time. So for instance, when we look at the monthly, right, you guys will see now how long typically the cycle goes from the bottom to the top. This is the bottom cloud and this is the top of the cloud, right? So this, what you guys see is top. The middle line is the middle of the top line. This is the middle of the cloud here. We call it, in this case, it would be called the monthly mid. Does that make sense so far? So let me see.
Yeah.
Yes.
So this would be the monthly bottom, monthly top, and this is the monthly middle of the cloud. And they're, treated basically as a key support and resistance levels. As you guys see, for instance, SPY just reached the top of the monthly cloud here, right? It's inside the top of the monthly cloud. And if I look at the monthly MACD on SPY right now, indicating that it's negative 163, that means the cloud on SPY on the top is closed. Right, so I believe there's a setting here that will give you guys.
So does closed mean it's a stronger support or resistance?
it's a stronger resistance when it's closed, right? So we'll cover that here in a second. When the cloud is closed, especially like this one here, that I had the shading enabled on this, but let's say this one is closed because that's what the monthly MACD is saying, that this one is closed negative 163. As long as the cloud is, in this case, less than -1, that means it's firmly okay closed. For instance, on ES, if we go here, you see the MACD on this one. It's -18. So the odds are that this is fairly good closed cloud, and it'll be very, very hard for price to go through it. Does that make sense? So that's the open and cloud. But whenever it's on the monthly time frame, this is a pretty big deal. When you're approaching the closed cloud, let me see if I can bring this over so you guys can. Okay, so let's change this cloud to be here. Remember, the candles and the clouds, they have a different, how do I explain it? They're a different aggregation of periods. This cloud is tracking the daily movements. I'm going to change this cloud to track the monthly now and give me where is it in terms of monthly clouds. Okay, so here we came perfectly to the bottom of the cloud, right? We came here, we tapped it, and now we can see that, the cloud is struggling a little bit. I'm sorry, the price is struggling inside of it. We just tapped the middle of it at 620, and the high here is what is like 62.86. So at this point, for me, I'm more inclined to be cautious on the long, and I'll be very, very interested in a short if this was to break 6100. If this breaks 6100, then the rule says, right, that there's a high chance that we can go from here now all the way down to about 5500. Ideal scenario is when there's only 4 setups that I ever look for on clouds. And they appear on the top and on the bottom of the clouds. So for instance, one executed here, and it was perfection. When the price goes above the cloud, like it did here, if you guys see, price was a long time above the cloud here. Then it dips inside the cloud. That's called intrusion. And then it goes here, right? It rejects the cloud. That is setting up for a bearish money shot. You can call it bearish continuation play. But it has to tap in this cloud. And ideally, what you want to see, and here, initially wasn't, but the cloud closed. So this typically I go heavier on the put side right now. So it's setting up almost the same scenario. If they can just lose this, it's a pretty good level to go short. From here, what you target is the first target is a monthly mid, and the second is the monthly bottom of the cloud. Okay, so this will be the setup on the longer time frame. And you might ask yourself, well, how long do I play these puts out? Well, on the monthly cloud, typically, and I have a counter somewhere. Let me see. Let's see. What's it called? So I came up with something to tell me how long does it typically on average take to basically go between these, right? And I'm sorry you guys can't see it. I can change the colors on this. Leave that one. No, I'll have to go in the code.
Hey, Shorty. Sorry to
Yes.
interrupt. I have a quick question. How did you say we get access to that SKC indicator?
Oh, you can just send me a message if you don't have it with your trading your username, and I can make sure you have it.
And should we already have it if we have access to your orbs cloud?
Orbs are a different study, right? So just shoot me a message with yours, and I'll make sure you have it.
Will do. Thank you.
Okay. So here, I just changed this color here. You see how now it tells me the average right? Number of cycles that it takes, and in this case, right? So if you guys look, bear average is cut in half in terms of bull average to reach the top and the bottom of the clouds. Do you guys see that? So what does that tell
Yeah.
me when I'm calculating it? If this from here took 81 days for me to reach the bottom of this cloud, is going to be 40 days. So if I know that and I'm ready to buy puts at 6,100 and targeting, let's call it first, I'm targeting 55 and ultimately 4,900. So I would take 40 days, and I typically, just me personally, I would typically add some cushion to that 40 days. So that'll be like a month and a half in terms of trading days. I would make that 2 months to 2.5 months out, and I only trade monthlies. Does that make sense?
Yeah.
It counts, and then I'm able to figure out what do I need to buy for out so I can make money on it. So this is a monthly cloud, and this setup right here that was just basically played out is a bearish money shot. And you can see how quickly that went, right? Whether it was tariff news or whatever you want to call it. Typically when the price goes inside of it, right? And you can see here as well, it really accelerates to the downside. And this right here was probably one of the better shorts here in a long time, is because we came in, and remember how I said the cloud here wasn't necessarily closed. Like you see how the shading started, right? Like right here. But on the scenario, I believe 2020, whenever 2022, like right here, you guys see the difference between the cloud. The cloud was closed and it came here, and then a beautiful retest, and then the target would be here. And you see that it's struggled on the mid. They bounced off the mid from the bottom, which is also a short, and then it completed the whole cycle from the top to the bottom. And this is telling me on a longer period for the monthly, because I'm on the monthly, not necessarily candles, but the cloud aggregation periods on the monthly. Typically, you can find stocks, and we do the scans for stocks on the monthly clouds. Okay. So that's the big deal about the clouds. And this was a bearish money shot that we played out. Now, when stocks come back, let me show you guys a bullish scenario, which one just played out as well. So everybody okay with the clouds, understanding the bearish money shot or bearish continuation is when you're above the cloud, you lose it, you step inside, and then you test from the bottom, the top side of the cloud. Most likely you target the bottom. Make sense?
Yeah.
Yes.
I'll share the
Yes.
PowerPoint so you guys can get it. Once the first, once they break these, right, clouds, right, you see that here they disagreed, they came back here. When they revisit this cloud on the break here, this is called the bullish backdoor, meaning you went above, right? You went above this cloud. Now you're coming back for a retest. And most likely, what I typically do here in terms, let's say I had no idea about previous levels. This is all-time highs. I typically go with some kind of swing high to swing low, and I find the 1618 target on this, which would be somewhere around here. And you can see that it achieved that. From this cloud, I would target 1618, and they came back to it perfectly, and that's kind of where it stalled before it continued. And then the same thing happened again, but this one didn't play out. So if you guys look, this right here, it went up again, and then it's coming back to a cloud, and look what happens. They came back again, but they didn't reach the 1618 and 6374. So if they're to break this would be the target that they're going for, 6374, to complete this cycle, and then it would be a chaos. Okay.
Do you recommend the ashy candles with the clouds? Somebody's asking.
Always.
Yeah.
Yes, always. Yeah. Yep, I always recommend that with the clouds. Okay. So that will be, the bullish is when you go above the cloud, and I'll share the PowerPoint that explains the setups, right? You go above it and you retest the top of the cloud like here. That's a backdoor, that's bullish backdoor. And then the bearish money shot goes when you break the cloud and you're not able to gain it. And that's where you're looking for short, especially if the cloud is closed. We're still in the bearish scenario in terms of clouds because it's fairly close here. Does that make sense so far?
Yep.
Yes.
Okay. The clouds come in with different, I would say, aggregation periods. The ones that I use, for instance, let's look at the 4-hour one. 4-hour one I use mainly for, I would say, for intraday price action because it can reach the top and the bottom of the cloud daily. And you see how the cloud's not showing up. It's because I'm on a 4-hour cloud, but my candle is weekly. I need to be below 4 hours to see the candles, to see the clouds. And now you can take a look right here that, for instance, it can happen in a day, right? Where cloud, it goes to the top to the bottom here, fairly quickly here between the 4-hour clouds. And this you can use for intraday or for the weekly, just for a week to understand what is moving, what is not, right? In terms of clouds. My standard for analysis is monthly, weekly, and daily, and then 4 hours is more intraday, okay? So if I take a look at now if I flip this, right, and I put this on the weekly, I'll be able to see, hey, what is the weekly expectation of movement for the stock? Right, so let me go here, and I'm going to increase this probably to about a day just so I can see it. And here's this. So now, if you guys are following, I'm at the monthly top, I'm at the weekly top, correct? The bottom cloud now flipped, right, is closed on the bottom, open on the top. So the weekly is opening and saying, hey, we can go higher, but the problem is the monthly is not. Following so far? And you can definitely kind of lay this over, right? So I can duplicate this. Let's see. I can type in shorty master and I can add this, right? I can add it 10 times if I want. I can change this to be, I can put this to be monthly. And now you will see another cloud here on the monthlies. Let me make sure which one did I change. And I can put this one to be, let's say, quarterly here. And then I can have all the clouds. It just, to me, creates a lot of confusion, right? And I can definitely color code these in my, I would say, format here. I have the ability to change the colors right here, like primary bands. I can change the colors, let's say to be pink. Can do that. And now you see that that one is pink here, like that one is weekly. So the weekly cloud has the pink outer band and inside band stays white. I can color code it. So now the problem for the stock market, as you see, is whenever there's space between the clouds, price tends to go quickly between it. So like between here and here, I would say it went, dragging along, it went rather quickly, didn't stay like this. When the price is convoluted with these clouds here, it's going to slow down and there's going to get a little choppy. And I think that's what we might see here in the near future. So a retest, to 5,800 to 5,700, I would say is highly probable, just based off the clouds. Look at these clouds, whether it's monthly or the weekly, to understand where is the price at in terms of all of the clouds. So the monthly cloud, it's at the top, right? And then you see the weekly clouds there as well. And then you're able to see the quarterly, right, is also here. And here's the quarterly bottom and then the quarterly mid. So if let's say I change this guy right here. Change this one to be like this. So here's the quarterly mid is sitting at 4,600, which tells me immediately that this is the top, right? And then the bottom of the quarterly would be here. So now I'm looking at the price action. I have to be aware of the quarterly because if it comes back to this level, what could happen? Based on the two setups that we covered. So I'll just hide this one for now. I'll hide this one. Okay, so this is my quarterly cloud and you see that we went above it. So now if we come back here, is that extremely bullish? or bearish?
Bullish.
It would be a bullish setup, and I have to be well aware of this level in terms of cloud, so that way that we don't catch a bullish backdoor right here. And as long as, because this cloud is now open, right? You see the bottom. If this one was to close on the top and we're coming from the top, what do you think that means?
Wouldn't it still be bullish because it's closed and it's a strong support?
It would be extremely bullish, and that's a no-brainer. Go long and forget about it, and you're looking at the next leg up. If this was to turn, to close there, that would be phenomenal. So this would be a pretty good setup. Let's see. So does everybody follow kind of, and then, when we search for stocks, we might not have time to do that because I have to help my wife soon, but when we search for stocks, what I do is basically I would say, hey, give me all the stocks that are trading on bottom of the monthly cloud. I would say, give me everything that's here, because typically what happens here, and if you go back in history of any stock, here, take a look what happens. Do you see the pattern yet? Most of the time, the price will stay within the monthly clouds. Rarely does it ever kind of go, here's your 2020. When it dipped, it came back here. And then what happens is, especially if this corresponds with another cloud key level, top, mid, or bottom. So now if let's just say I change this one here to be quarterly, and I can enable it. Now I can see, for instance, let's say when that was happening there, let me hide the weekly for a moment. This is quarterly. Let's hide this. So now you can see, for instance, that March, when it was happening here, right? And on quarterly, automatically what happens, and it gives me opportunity to know where, there's potentially some traps above these lines here. For instance, it dipped below the quarterly, but which was the monthly bottom here, and I was given a kind of a cautious sign, that there's a high chance that they're going to bounce, for instance, here. Same thing happened here on October. And now you can see here, we came very close to the quarterly here, but there's a really, really, there's danger here for I would say for the late bulls, right? Because everybody's been momentum-wise, MACD-wise, it's been a pretty big bearish divergence setting up here. So when I look at this, I have to look at it monthly, quarterly, what level is in a way, and I would typically say, hey, this is, I would mark this like right here, and I would mark this and say this is Q mid, meaning quarterly middle, and now I know where the quarterly middle is, and I would know where the quarterly, for instance, this would be, the bottom is 1.5 band, the outside is the 2.0 band. So now I know if you're to lose this 55.20, very high chance that you're going to be executing to 46 from the quarterly higher time frame perspective. Now I would say, okay, well, give me the monthly analysis, and what are you seeing here? So I see here, right, immediately that this is the 2.0 monthly top, 2.0 closed. And I would mark that on my level, and I would also mark this. And this would be my monthly top, 1.5 closed. So now, where's my highest and most probable trade that it's going to occur is once we lose the 1697, there's a very high chance we're going to hit 57.74, and it's going to be nasty quick. There's no clouds in between. And then if you lose this, you have this one. If you really don't, let's say bounce a quarterly top this time, then we're looking to go probably 49, 4,800 here. And then if I was crazy enough to say, hey, well, let's see, how does it look on a yearly? I could definitely do that. Change this to monthly time frame, and we haven't been to the clouds at 4,200 since we haven't touched this cloud since March 2020. So it's been a very long time since we had any touch to here. I would say a very long period of time. So you could mark this, but I don't necessarily look at that right now in terms of the cycles and how everything's going. So I would say quarterly, monthly, and weekly are good for long-term analysis, and then you could use daily and 4 hours for short-term analysis. Does that make sense? And then the same concept that I just explained on the bullish side appears on the bearish side. So if you guys give me a stock that's been dying or something that's been dying.
Thank you very much. It makes so much more sense now.
So now if you look at, for instance, let me just bring something else here. So we can share. There's a particular view that I like to use where all the clouds are combined and more like straight. Attach that guy from another screen. Okay, so here's, for instance, TLT, and I'm looking at all the clouds, and I just like to look at them straight because of just the simplicity of seeing this, right, on all in one cloud, right? So if I want to get rid of the daily cloud, I don't have to remove it. I can just be like, okay, give me the weekly, and daily cloud's gone, because I cannot have a higher time frame candle than the cloud itself. And for instance, see here, when I started acquiring some TLT here. My target is, we're going to chew through this, eventually 90 through, but this is where, I would say problems really start for the market, right? If we're able to crack through this, this is what I'm hoping for, which should be from here to here. You're talking about 60% gain on this, right? So I'm looking to buy stuff on the bottom on the monthly weeklies. So let's take a look. I think we had HUM last time we talked about. So here's, for instance, Humana. So right now, if I want to look at this on a monthly time frame, I would get rid of the weekly clouds, and I can see how did it play out previously. Last time we had a full send from here, and of course it just took off 220 to 600. If you bought it there, put some stop loss, you could have managed this. Now, if you look at Humana, it's coming up here, right? It's coming to the monthly, and if you go on the weekly time frame, you can also see it has a pretty decent setup. There's a lot of buying happening right now. There's a lot of accumulation, and the target for me, for instance, if I'm buying the monthly bottom shares, target is, which happens to be monthly top and quarterly mid. I guarantee you, at some point, I don't know when, this is going to be at 405. Requires patience, and that's why my long-term portfolio, like I said, I buy it, but I hedge it in terms of options. So that's how I correlate long-term. I buy the monthlies, quarterly bottoms. In this case, there's a lot of stuff in this one. I think the last one that we just recently had, right? You guys talk about, remember we talked about Nike here not too long ago, actually last week or the week before. We said this is just a no-brainer setup. And if you guys remember, I talked about this full sense showing up. Do you guys recall that from one of the watch lists, or I don't know which one we did? I talked about like, hey, Nike's ready to pop.
Yeah.
This makes no sense. And it popped 20% just now in earnings. And then I also said that I'm looking to offload. I offloaded some of the shares, and I also closed, I sold some calls on it. And does everybody see why I did that?
The cloud was closed.
It came to a cloud that's closed for it. So what do you want me to do? I have to take my money off, and I'll look for opportunity to get it back in when it comes down, right? So if you guys go here, and let's say look at Nike, for instance, here. I change this cloud to weekly. Look at this in 4 hours. So look what happened here. now that you guys have learned a few things, just pay attention to the shading of the cloud here. Shading of the cloud that happened way back on June 1st. Price is telling me the price is not going to go lower than this for right now. Does that make sense? I was looking to see where I can offload if I bought, and I did buy a little bit more than typical size. Here I added, and then of course, since I bought more than typical size, I would go, I offloaded some, sold some calls, and I'm hoping that I can catch somewhere around 62, 64 to reload on the stock. It was just a simple play of this. And then if I look at, for instance, here, this one, I'll change it to monthly. Now you guys will see it. I'll change this to daily. And now you're able to see kind of the cloud and what it means here. So here's our, let me delete the drawings. So here's us going below the cloud, right? So same thing that we did earlier. You go above, you dip inside, you target the middle, right? And then you target the bottom. When you go below the cloud, you regain it. And let's hope that this cloud, this particular cloud, flips this shading from top to the bottom. What do you think we should do then? And what's the pattern called?
Go long bullish money shot.
Yeah, it would be a go long, and we will look to go buy it on this cloud, which would be somewhere maybe here, right? That they come back and give us this like 65, 64, and then we will be targeting 84 or 85, 84, sorry, here, and ultimately we would look to get out somewhere around here on Nike. So this would be a bullish money shot. They attempted to do a bearish, right? And they failed to put in any lower lows. And then, of course, their earnings was just icing on, for the shareholders here. Pretty good. Does that help with clouds? Does anyone have questions on clouds?
Yeah, I have a
No, it
quick
makes a
question.
lot of sense. Thank you.
So the monthly clouds, are those, can you show me the monthly cloud on ES again? And what is the top of it? And
Yeah.
is that calculated on the last 30 days or just the last month? How do they do that?
Well,
Like it's
it
the middle of the
assumes that 1 month is 30 days, and that this cloud will only shift every month, meaning it will aggregate the prices off of the monthly attributes.
So it won't
So
just do like in the middle of the month, 30
no,
days.
it will just stay, and then it refreshes on the 1st and 30th, and it does it by itself.
Okay, and the same with the other clouds in TradingView?
Yeah, that's correct.
Okay.
Same period defines how frequently these levels are recalculated. So if you guys look at, for instance, let's look at Qs.
Okay.
So here's Qs right now, and we are on the monthly, and you see that the cloud just flipped to green on Qs here. So kind of clear that they're buying the tech right now. If tech was to lose this 532, it would be very troubling for them because they will be looking for 71. And then if you go here, you can change this to weekly and see where are we in relationship to the weekly cloud, and you'll see that we are right on top of it. I can also change this to look at the quarterlies. And here's your calculate quarterly. So here's the quarterly. If you guys take a look, we went below. Cloud was open, right? So it's able to kind of go through on the quarterly, and it did not stall much. And the bottom is of course closed because it's positive here. So they could bounce here nicely at 509. And if I go on higher time frames, if I really want to look at something crazy, it would be yearly, and you could see what is happening on the yearly here quickly, right? So cloud was closed at one point. Last time it was closed here. They struggled, they accumulated, they popped, and they've been riding this. But what's different this time is that they're slowly making, the higher highs are not as aggressive on the upside right now. So if you guys look right here, you see that, when they make higher highs, when they clear this one, they didn't go that far. And now they just swept the highs here. So now, I think 509 is coming on this. And ultimately, we would target 380. And if we're lucky to see this in near future, it would be ideal here. I would say we've had some really good stocks off of these levels. For instance, pizza was one of them. This one played out pretty nicely as well. And you see the setup that's forming on pizza right now is that if it comes back to 37, that's a no-brainer. Right, it'll be a pretty good level. We bought it at the monthly levels here. What else did we have? I think we had some luck with what was it, Zscaler? This one was amazing, honestly. It's probably one of my favorite ones that we've had. We've actually acquired it here, then it went, and now you see how this middle, it wasn't dropping anywhere. Now it's above it, not a place to initiate, but usually for long term, I use this heavily to find the stocks to buy them. Like I said, I don't share the Thinkorswim indicator. I think I've offered it for sale, I think maybe 2 or 3 times in the past with the kind of package it with the lifetime membership, which gives me make sure that we are still friends, that you're not going to abuse it, and you also sign an NDA agreement when you do get the cloud, so that way if you share that right to remove your clouds, and then also there's legalities of it, right? You don't do anything stupid. Any questions on the clouds itself?
No.
Okay. All right, guys. Well, I think I have to get going. Family's coming here about an hour, so I have to go. This typically I would have to go cut the grass. My wife's gonna be pissed too. That's my help. But hopefully this made sense, and that it's not too complex in terms of movements, because all you need is top, middle, and bottom, and then there's 4 setups, right? Bullish backdoors occur when you go above the cloud. In the first retest, you're looking for longs. When you go above the cloud and you retest, you're looking at the bottoms. And then when you go on bottom of the cloud and then you regain it, that's bullish money shot. And then you're targeting pivot or midpoint and the top. And then another one is if something is here, you're coming for a bearish backdoor, and that'll be here. So this is basically the 4 setups. You're looking for a long here. Here, you're looking for a short here. In this case, in a downtrend, you're looking for a short here. And this one here is if it goes inside, you're looking for a long retest here. And this would be our targets here and here. And this one is targeting, it's basically 4 setups with targets predefined. Does that make sense? It's just 4 setups with the clouds. Yep. And I just buy equities on the bottom of the monthly and combination of quarterly or weekly clouds. And a lot of times, like I said, I use my straight clouds just for the simplicity of seeing, where something is in terms of price action rather quickly. Like this is monthly bottom, monthly top. We can take a look at, for instance, Adobe. I'm going to be looking to acquire some here shortly. You can see, for instance, that one is on the bottom of the weekly, and you see that it dipped below the monthly, and now it's trying to regain that. So what I would do is let's see, where did I move this cloud? So if I look at Adobe, what is this? This is monthly cloud, and you see now we went below and we are setting up, and you see what happened with the volume here. Do you guys see the weekly volume?
Yeah, it started increasing.
But the price is not making lower lows. So that tells me something's happening, that there's an absorption of buying, right? So that's how I'm going to be looking for this. And ultimately, I'm not going to touch this till it reaches about $600. I buy and forget it. Okay. Well,
So those
hopefully
four
this is.
setups.
Mhm.
Last question. The way those four setups work within the clouds applies to quarterly, monthly, weekly. I guess all time frames. The same way,
Same
right?
setup.
In the
Yep,
sense. Okay.
same exact.
Cool.
Yep. And I have smaller ones as well that I use. Basically, same like the straight clouds, but they're just smaller. And if I wanted to use, you could use clouds literally just for scalping on the bottom. For instance, like these, you can use it on like 5 minutes, and you guys have these. And you can see now, for instance, let's change chart type. And you'll see here, for instance, here's same thing. You went above the cloud. I believe this is 30 minutes, the blue ones. Like you see how I went above, then I lost it, and look where it came back. It went lost the 30. Where did it go?
Down to the 30.
Down to 30. Your first target would be the blue line, which is the middle, which corresponds color coding wise. You see when you highlight it, it's telling me that most likely can offer a bounce. Then you had another confluence item called Full Send Baby, came back, and then they rejected it. They completed the whole cycle of 30 minutes on this one. And you could do the same thing on SPY. For instance, let's bring this one up on smaller time frame on SPY. Okay, so here's this one. So take a look what happened on SPY here. Here's your 30-minute. Here's your bottom. They tried to bounce it. They ended it. They reclaimed. They lost it. Then they reclaimed it, and they executed basically the bullish money shot 30 minutes. And you guys have the trading view. I would say, unfortunately, TOS probably more accurate just because the data and how trading view, I would say, aggregates the data is a little bit different versus a real trading platform in terms of data and order flow. They use Denali. Ameritrade TradingView doesn't use Denali service. So that's why it's different. And it's very hard to, I would say, match it from the code perspective. Unless somebody's an expert in code and can nonstop change it. That would be doable, but I don't know how.
Is that difference negligible? I mean, in a sense, like a couple points, or is it something to worry about?
No, nothing to worry
Okay.
about, honestly.
Okay.
On those higher time frames, typically when I buy, like for Adobe, right? If it's different, $10 on $300 stock, yeah,
Gotcha.
especially if I hold it for 600, that would be even on the profit side, $300, $10 difference. That's less than a few percentage points.
Mhm.
So I wouldn't be bothered too much by it, if that makes sense.
Understood.
So are you already in the Adobe trade or you're going to take it Monday?
I'm going to be looking to get in Monday. I'm going to
Okay.
start accumulating Adobe, not full size yet, but I'm going to be cautious because of the quarterly bottom. I think they can flush some people out on that. Let me see, where's my other cloud? I have so many screens now open. So if you look here on Adobe, there's a little bit of concern, but I'm seeing buyers step in multiple ways. So if you guys look here, you can tell, if I just go on the monthly, just get rid of the bottom here. Last time when we had a full send, you see where it came from. This is a quarterly cloud. This full send showed up off the quarterly. If this was to happen again, it was just a no-brainer. At least not for me. When I trade, I trust the system that I have, and I would take this anytime. Right now, if you think about price action, we're making higher lows and we're making lower highs, and that means that we are consolidating, and we're consolidating at much higher prices. And this is not a bad spot to start acquiring. The only caution I have is if they decide to trap more people and do this, that's certainly possible as well. But I'm gonna start getting some of it right now. And the dividend's actually pretty good on the stock, $5 a share. It's not the best yield, but $5 is a pretty good amount. All right, guys. Well, hopefully it was a decent session that we cleared up at least the clouds, that we started maybe introducing some of you guys to the idea of options. I think we can go next time a little bit more practical use in terms of finding what do you target on stocks, on ETFs, or how do I use futures to buy SPY or SPX? Some of those questions might come in handy with the answers to some of you guys as you trade. So I think that we can save that for next one.
Good class. Thank you.
All right, guys. Well, thank you, and I'll
Yeah,
see if we
thank
can do a market
you for your
update
time.
tonight,
Thanks,
probably at
Jordy.
9 p.m.
Thanks, Shorty.
And if you need the
Thanks,
clouds on
Jordy.
TV, just shoot me a TV username, and I can't promise I'll get it today, but probably by towards the end of the day, I can get it for you guys.
Thank you, Shorty.
Set up. Mhm.
Okay, great.
All right, guys.
Thank you.
All right. Have a good day. Bye bye.
You too. Bye.
Thank you. you.